No mic.
Test. Is that the right mic? Is it?
Okay. Oh, I guess I'm starting kind of late today. I do apologize, guys. I don't have my stuff set up. Let's see. To meeting. People online are probably like, "Where you at?"
Yeah.
Let's see. Am I not logged in?
Oh, do you know who brought this tech analysis?
Yeah, it's Bob.
Is he here?
He'll probably be here.
Okay,
Maybe.
if anyone wants it. You want the report?
Yeah, he gave one to everyone.
I copied it.
Okay. All right. So hopefully today I'll make you guys more passionate about investing.
All right.
After what we're going to talk about. Oh, you're going to sit next to me? Okay. No problem. Yeah. Feel free. Oh, you look for an outlet. Yeah, I do apologize for that.
That site doesn't have it, right?
Yeah. Okay. Just 1 second, guys. Get started over here. Share my screen. Okay, so, the way it goes, I normally give about 15 minutes before the students come in. I'm just kidding. But that's kind of how it's like in college, right? But after about 15 minutes, people start coming in. So usually I kind of just leave it open to kind of chat about, anything you guys want to talk about the financial markets for the week, right? Not too much. Any questions or any experiences this week that you guys like to share before I get started? Okay, well, that's fine. So today's topic, guys, technical discussion number 105. We're going to talk about bonds, central banks, and wealth inequality, especially the wealth inequality part. But I won't start until 15 minutes later. So in the meantime, we could just kind of take a look at some stocks and stuff, maybe an update on the gold position that we have. So for those of you who just came in, you guys are new, I am pretty bullish on gold. Main reason is that there's several layers of risk that I'm kind of seeing, mostly at the sovereign level, sovereign risk, so central bank risk. There's more assets that's been bought so central banks have bought more assets than ever, and it's starting to look kind of scary. Now, as they try to reduce that asset level, it's causing a lot of stress on our economy. So this is what it looks like, just kind of skipping ahead the discussion today. So we're going to go deeper and look at this chart. Pretty cool stuff. Are you guys familiar with this chart? Anyone? Well, I know you guys are. Yeah, so this is the central bank, and basically the amount of assets they acquired over the years. So since 2008, when we had the recession, if you know the gray area, that's the recession, they started buying up a lot of treasuries. And when they buy a lot of treasuries, they deploy money into the economy, just to kind of juice the economy, right? And so that's where we see a lot of asset value start to appreciate. So everything from like real estate to stocks to bonds and such. Just something to be aware of. Yeah, so it's still early. I don't feel too comfortable starting yet. I don't want to make it awkward
we've got a
either.
couple interesting companies doing their earnings this week. You could look at Cisco.
I mean, we could look at that as well. Are you trading earnings? Just out of curiosity.
I pay attention to it because I know that on earnings, they'll either go up 5 or down 5% every time.
Yeah.
So if you guess, it's really guessing what the guidance is going to be, right?
Now, Bernard, I do want to ask you, like, your sentiment on the market. It seems like you're the most bullish one in the room. Would you say you are, or? Hey,
So I'm bullish on profitable, successful companies. I think they're going to continue. They're going to gain in strength.
Mm-hmm.
So companies like, some of my favorites, like Microsoft and
Right.
Boeing and Cerner and,
Right.
and Intel and others.
Right.
I predict that those aren't going to double, but I think those stocks are going to just keep on moving up slightly. So you might get a 10% return, 15% if you're lucky, but they're not going to double.
Right.
And so those are like if you look at that graph, I think that graph is going to just keep nudging up.
Yeah, from a bigger perspective, I really do like the Microsoft chart. For me right now, I am using Microsoft as another proxy, a technology proxy, because of their size. just to kind of gauge where the economy wants to go, right? And for the most part, it's been going up and down the 200-day moving average. So the 200-day moving average is the pink line right here. I'll continue to monitor this. If you guys remember, I said before, some of the guys that I do respect in the financial markets, they're short Microsoft, which is insane. Because they personally think Microsoft's a little overvalued, and also Salesforce. You know I'm bullish on Microsoft and Salesforce, right?
I'm bullish on Salesforce. I don't own Salesforce, but I'm bullish on Salesforce
Yeah,
for sure.
yeah. So it's kind of crazy that they're looking at a short angle, just because I guess their fear of global macro is a little bit overriding. Yeah.
Is there a way, can you put up an S&P 500 weekly chart?
Yeah, we can do that.
Because
Real
what's going
quick.
to happen is, we can refer to this when we look at any stocks, and they're all going to do pretty much what this one is doing.
Yeah.
You see how it breaks below the 50
Right,
in May?
right.
And it goes right back to the 50? That's all the company's going to do. And from the day when this S&P started going up, 7 weeks ago, all the companies started doing it. So my point, if the S&P starts to go down from here, all the other companies will do the same thing.
Right,
So
yeah.
if we just look at the S&P, it's going to tell us exactly what's happening with everybody else.
That's true. It's like all boats rise when the tide comes in.
Exactly, it's so important that concept.
So this is your S&P 500 weekly.
See the break below the 50, aggressive break all the way to the 200 in May, and then we're going to go right back, and we're right at the 50 right now, which is going to be the moment of truth for the next year.
Yeah.
If we break below, we're going to retest 23.46. If we break above it, we're going to go to new highs.
So we do have some new people in here. What was your name? Sorry.
Oh, I'm sorry. My name is Ivan.
Ivan. So
Yeah.
Ivan and Even.
Ivan.
Ivan?
Ivan Singh.
Same thing. Okay,
Yeah.
just the way you pronounce it, right?
Yeah.
Okay. Well, hey, well, welcome, guys. It's kind of weird that you guys are sitting so close to me, but I do want to make a little introduction because I normally give about 15 minutes for people to come in. This investment club. Well, you met me at the mixer, the technology mixer,
Yeah.
and then we were kind of talking about central banks and stuff on the monitor that was outside over there.
Yeah.
But basically, I've been running this investment club for more than 2 years now. So I like to number it, and so today's discussion is number 105, right? So we've been doing this every Sunday for 2 years back. It started out in the Milpitas Library. Actually, it started off at Starbucks with just a few people, and then moved to Milpitas Library, and then we ran out of space, and then now I'm here, right? So for the most part, we do run this meetup online, offline. So the physical meetup is here, but there's also people that are kind of logging online right now. So for the online portion, we got about 11 people online right now, it looks like. Hey guys, people online, can you guys hear me? Let me know if it's okay. Just want to kind of getting started here. The mixers we started doing about, yes, okay. The mixers we started doing about 6 months ago. So the last mixer that we talked at was mixer number 6. So I'm going to try to do one every month, just for the sake of building up a network, right? So the 3 things that I personally value is financial wealth, knowledge wealth, social wealth. Well, personal health too. So those are things that I constantly am mindful and want to build out. Because I always say this, you analyze businesses long enough, companies like Facebook, Apple, Google, one of their biggest expenses is marketing. So one way to nerf the marketing expense is really just to have a network, right? So one way that I actually practice what I preach is, for example, LinkedIn was acquired for $26 billion by Microsoft. And so I'm aware of the acquisition, but for me to get exposure to that, one way is to trade options on Microsoft or trade stocks on Microsoft. The other way is actually to play the ecosystem of LinkedIn. So I'm very aware of LinkedIn's capability and how Microsoft perceived that investment to be, an appreciating investment. So I want to be very active on the LinkedIn ecosystem as well. So I'll show you guys some example. Guys, this is just for fun right now. We're not getting started yet. A little reminder. So some of the posts that I do, right? So the power of networking. Let me see. So I posted this one yesterday, right here. So it looks like, yeah, you get like 15 likes, but I get about 2,000 views, 2,400. It will grow over the period of the week, right? So one of the posts that I did, I don't really post my own stuff, not yet at least. What I do is, you have to play the game of the ecosystem. So if you guys invest in software long enough or applications, any software that people make, it's basically a game. There's a gamification thing behind it, right? Like Facebook, people are going for more likes, more social connects, or more engagement. So every software, to me, I kind of view it as a game. So within the perimeters of this game, meaning how could I operate in LinkedIn and then rank up to the higher end of the population or the economics here, the economy? So to give you some numbers, if they say in a 2016 statistic that if you have more than 10,000 connections on LinkedIn, because it's an emerging platform, then you're considered about 1% of the economy in there, right? So just something to know. But let me just show you some of the marketing power. So here's one right here. So this one was like one of my good ones that I shared, and surprisingly it gets a lot of views, right? So simple as that. I just share it. Got 186 likes. Total views right now is 26,000. That's the power that you can't get locally. Yeah. Hey, Kathy. Have you been going to the online one, or I think I saw you. We saw you on
Yeah.
webcam once.
You saw me?
Yeah, I think you turned on your webcam on accident.
I know.
Yeah.
I was trying all this thing. I was like, how do I ask questions? I
Yeah.
couldn't.
Yeah.
It's okay if you get big enough, let's just say,
Yeah.
you put a post that says, I believe that XYZ stock is highly undervalued.
Oh no, I can't. No, that's.
Well, you're just renting an opinion.
I could,
right?
yes, but
I mean,
It's
it's all like
illegal,
you're.
right?
it's not.
illegal.
No, it's not
illegal.
illegal. I would have to disclose that it's for educational purposes only, and then probably say that this is, I'm an investment educator.
But you're like a
No.
fund manager, you can't do that, right?
Yeah, if you're a fund manager, there's a huge conflict of interest. You don't want to do that. Hey, welcome, guys. What was your name again? I forget.
Mahmoud?
Mahmood?
Yeah.
Hey, welcome
you
back,
could,
man.
You could present some argument that
Yeah,
says
yeah.
this particular stock, et cetera, my analysis says
Yeah.
that the Salesforce stock is undervalued by 15%.
Yeah,
And I predict by the summer, this stock will have gained, et cetera, et cetera. I mean, it's no different than Barron's where,
Seeking alpha.
Yeah, you're right. You're right.
Yeah, different.
Yeah, you're right. I could. I'm wondering why you guys are here then, if it's all online. No, I'm just kidding. Maybe that's something I'm looking into. But for the most part, I'm leveraging LinkedIn to further my own social wealth, source my own deals, but also deals with the company that I work for. Right.
Yeah.
Just recently this week. So new update. Last week we had a discussion. It was number 104. We talked about China and China's adaptation of technology, how their economy is. So were you here, Joseph, last week?
was online.
Oh, you were online. Did you enjoy that session?
Huh?
Did you enjoy the session?
Yeah.
Yeah. So we talked about how their economy is sort of evolving. For the new people here, I guess I'll pull it up because I know you kind of see it. I'm buying time right now for more people to come in before I get started. So I'm just kind of retracing back to what we talked about last week and stuff. So
Can you look at AMD?
can I look at AMD? Yeah, I could look at AMD. Let me pull this up real quick. So this is number 104. So I guess I kind of inspired myself. Hey man, I kind of inspired myself with the Chinese discussion or the Chinese economy discussion that we had last week. Just kind of analyzing their economy and how much they're adapting the mobile space, right? And so I'm constantly, as a critical thinker, I'm constantly battling myself, thinking about, should I invest more time in the physical world or more in the digital world, right? So I told you guys, every year I kind of have a goal for myself. I'm a type of person that sets a theme, goal, or achievement for each year. So one year it'd be like build a community, which was like 2 years ago, and this is where the community is today. Another theme would be like get better at the sales stuff, the cold call, sourcing deals. So been there, done that. Another one was like just get better at investing. So this year, my 2019 theme is actually to be more, to build out a digital economy, be more digitally native or whatever. So last week after talking about their economy, how fast they're growing at that pace, I got inspired to go out there and buy a product, right? So I'm not advertising anything, all right? No sponsorship here, but I bought this product right here.
Well, it's not-
I bring some cookies to celebrate our RPD trade.
Oh, okay, all right.
Is that a gyroscope camera?
Hey, thanks so much, man. Huh?
Is that a gyroscope thing?
Yeah, so it's a gimbal. So
Yeah. Very cool.
yeah, very cool stuff. So it's a stabilizer, right? And I'm gonna start making videos. So I won't show you guys the videos yet.
Oh, that's neat.
I'm already doing it in the back end. I've been uploading videos, but I won't tell you where. I want to hold the surprise, right? Because I want to test myself to see if I'm consistent first, if I can build out this online community. But I'll be honest with you, right? Whatever we talked about last week, or just in general about technology, the way technology is growing, with the whole AW, so Intel chips, AW. Okay, let's start from the top. Let's say Salesforce sits on top of the Force.com platform, sits on top of AWS by Amazon, sits on top of like Intel chips. You start seeing all these layers and they're all connected, right? So, and I always talk about how the physical reality world, how many people could really come to this meetup? Only like 30. This room, I think the max is like 30, 35, 40. But online, I could scale up to 100. So it's just the economies of scale is there, right? The efficiency is there, and that's something you want to pay attention to. But for the most part, this is a cool device to just, make videos and do vlogs and stuff. So let's try it out.
It's not the one you can hold with the iPhone, the same thing, right?
Yeah. So I actually could connect this to my iPhone right here, and I'll hold it like this.
So built-in stabilization? Is that the
Yeah,
idea?
that's the beauty of it. So I can move around and chit chat.
That's cool.
So what I'm actually doing is I'm going to build out more of an entrepreneur investor channel. I'm not going to share with you guys yet. That's until I establish consistency, right? So just like this club. This club, I'm able to say some stuff, which is okay because I've been doing it for so long. But anyways,
How
back
much is
to
that thing?
this thing's $350.
Oh, wow.
Yeah. $350 probably worth the investment if you're going to build out a digital ecosystem, right?
HD camera?
Yes, for the most part, I believe it's pretty high quality.
Is that one actually for the sport, more like usually for sport or what that kind of? You go outdoor activity?
Yeah, so the gimbal is you could do it for sports. I think GoPro is more for sports.
Oh, this is not, that one's not.
This one's more of a like on the go pocket, right? So, so you guys all watch YouTube. I already know that, right? Just because the pure economic strength of Google and the economy of scale they have. Do you guys ever ask yourself or catch yourself seeing what you watch? Like what type of content do you digest? Maybe investment content, but how about other content? Business content, right? It's pretty easy, but any other like, there's like different categories of content on like YouTube. There's like junk content that people really, well, in my opinion, okay, it might be insulting, but in my opinion, I think some of the content is a little bit of like time wasting and junk. For example, ASMRs.
ASMRs, what was that?
I don't know what it stands for, but basically this whole trend of like listening to like, sounds in high detail, ASMR definition. So the definition is, let's see. It's like a trend that everyone's kind of doing right now, and it's great marketing for let's say S&P 500.
I'm not growing. Is there something wrong with me?
Are we just a couple of freaks?
Yeah.
We live in a society.
Yeah, like I don't know. It's just like the whole sound stuff.
Yeah.
I'm not trying to promote anyone, but
That's new in here.
yeah. So here we go. So people who just get turned on, I guess, by the sound of random stuff. Yeah. So things like this is getting views in like, look, she has 1.6 million, and then you got 200,000 people viewing this stuff. To me, it's just
That's hard to believe.
it's a little insane, but that's something that's going on in the digital economy, right? So you guys know me. I got different pulses in global macro economy, stock market economy, digital economy, physical economy, local economy, SMB economy, real estate economy, whatever. A transaction is a transaction. But I'm seeing a lot of strength in that end, and so I want to push that market a lot more. But anyways, done with the digress. Let's jump back to today's discussion. And you did want to take a look at AMD, right? Let's see. Let's see this one real quick. So this gentleman brought in some cookies. What was your name again? I forget.
Bill.
Bill? Hey,
Yeah.
Bill, thanks so much for bringing in the cookies.
Yeah. I didn't trust you so much at the first talk, so I only buy a few hundred.
Okay. So if you guys remember,
From 35 to 44.
yeah. So I mean, when you get a move like this, I try to take some gains. So Bill just brought in some cookies in the back, guys. If you guys want cookies, thanks for bringing him. He stays for the celebration of RPD, Rapid 7. So we looked at this security 3 weeks ago, maybe.
Yeah, think
I forget, something like that. But it came up on my radar several times, and I just saw some bullish activity. And I guess you capitalized on the opportunity, right?
Yeah.
Yeah.
Okay,
So
that's great.
So not bad. Twilio's another one. So I know earnings are coming up for these, so be careful, right, guys? EA had earnings. That one I was kind of trading around the day, but I did see a dip buying opportunity here. This is a reversal to me, right? So this is what happened. So what I saw was, again, we always look on the daily time frame. JC's favorite time frame is weekly, but that's okay. your preference, right? So what I saw was that at the very peak, about 150, and we had quite a bit of a decline all the way down here to like 75. And to me, that's about 50% off. So fundamentally, from the institutional guys or the fundamental investors, my thinking is that, hey, they're looking at 50% off, they might want to try to buy some. So what I saw initially was, okay, a spike right here on some decent volume, and a nice sideways consolidation. So I wanted to play some, intraday trades because I thought this thing would break out to the upside. Hey guys, welcome. Hey Zainab.
Hey, how are you?
Good, good. Feel free to find a seat. We're kind of just getting started here. So what happened recently was that they had earnings, and then it gapped down really hard. And I thought, like, wow, maybe this thing could go down, but it did not gap down below the previous low, which is right here. So, from what I saw, I was talking to Aaron. He's in the room. He's in the back over there. That I saw a dip trading opportunity. This thing was down like 10, 11% on the day. So whenever I see a 10, 11% on a day, I like to do day trades, where you can just kind of go into something like this and do 100 to 200 shares or whatever. I normally play options though, but yeah, just 100 or 200 shares and it'll go up. Let's say you're down 10%, you get like a $4 or $5 move, right? Little did I know the next day, next few days, this thing went up like $12, $13 right here. Insane, right? So I think institutions are kind of eyeing this, especially at high volume. I know you can't see the volume anymore, but that's what I'm seeing. And then real quick, we'll take a look at AMD, and then we'll start today's discussion. So this is AMD, guys. How do you feel about AMD? Like,
I'm thinking of selling.
you're thinking of selling, okay.
I'm trying to find
Semiconductors right now, I'm a little bearish, right? And a proxy that I use to track semiconductors is SOXX. Or SMH, another ETF. Reason why is that, you listen to like some of the recent semiconductor earnings right now. A lot of the leaders, they're a little bearish, or they're giving forward guidance, seeing negative in Q1, negative sales in Q1. Not negative sales, but 15% decline in Q1. So I'm not too bullish on semiconductors yet, unless the proxy SOXX manages to go above the 200-day moving average, which it already did, but sustain this. So I'm still at a point where I'm not too confident in the global macro economy quite yet. Fundamentally, I feel, let's start right here. So fundamentally, I feel bearish, and we talked about this for several weeks already. Oh wait, this is not today's discussion. Right over here. So how I feel, market update. So okay, let's start from the top. Today, guys, technical discussion number 105, along 2 years. The topic of discussion is bonds, central banks, and wealth inequality, especially the wealth inequality. I know we talk a lot about stocks, technical analysis, and all that, but sometimes I like to take it back and kind of observe at a global macro level. Maybe we've been doing that a little bit too much as of late, but let me know if you don't like it, and we'll change it back to something else. So market update, how I feel. Fundamentals / economics, I feel bearish. Right? We talk about the sovereign distress, especially the central banks. They printed money like never before, and we're at a level where it's just a lot of uncertainty at the global macro level. And we're seeing this across the world. It's not just the USA economy. We're also seeing Japan, another major economy, and also Europe. Right? Those are the three major DMs. DMs as in developed markets. They're pulling back pretty hard. We could take a quick look right now at what the futures are saying. So this is for new people, this is spinviz.com. This is my portal to access the global markets, right? Anyone could do it. So for the most part this week, I saw that...
Does it have a subscription? Or?
Yeah, I paid $350 a year for this, but the free one is good enough for a beginner. I wouldn't recommend paying unless you're really going to dedicate time to this.
you can get a free one on this site.
Yeah, the free one is there, but they'll give you a lot of advertisement and you won't get live price data. So I like the live because, if I want to do a trade, pull up the live. Yeah. So for the most part, we're going to analyze global macro right here, guys. What I noticed this week, something changed this week. For the most part, if you guys are watching the indices aggressively, like the S&P 500 or Dow Jones or NASDAQ, a lot of them are hitting the 200-day moving average and hitting a lot of resistance, right? But across the world in the other major economies like Japan and Europe, I started seeing aggressive selling right here. Okay, I drew that circle a little too big. So Nikkei right here. Say again?
Germany.
Especially Germany. So yeah, so Germany's right here. So I think the spillover, there's a potential spillover across the world, right? To the USA. So I personally think we might revisit that 20% dip So if you guys recall, Apple, one of the biggest, well, it is the biggest corporation now at about 700 billion market cap. At one point, it was at 1.2 trillion, right? Now it got knocked down all the way to 700 billion. Huge deflation. But home prices kind of still went sideways, but that's another reason. So I think there's potential for indices to revisit that 20% pull down, right? Especially what's happening at the sovereign level with the whole 50 billion quantitative tightening, meaning they're tightening up the economy. And so asset prices, you won't see asset prices appreciating right now. So for those who are like professional money managers, they might be taking money off the table or just increasing their risk management. But that's what it looks like in Japan, guys. And then over here is Europe, right? So I'm seeing selling right here. Don't see it quite yet in the U.S. moving forward, but
Did this start like a couple weeks ago or recently?
this week.
This week.
This week Nikkei or Japan and Europe, I started seeing slightly aggressive selling, right? And I'm thinking the week moving forward with us at the 200-day moving average on the indices, we might get some selling. So I want to be.
China's market comes back to the vacation flow.
Yeah, so let's look at emerging markets as well, right? So this is EEM, let's do this on the other chart. So EEM, because we look at developed markets, we also want to look at underdeveloped markets, which is emerging markets. EEM right here. So again, we'll look at it on the daily time frame, 10-year out. So same analysis. I did note last week that it broke out above the pink line, which is my 200-day moving average. For those of you who are new, the 200-day moving average is a very popular moving average that everyone uses. Retail traders, big retail traders, money managers. If everyone's using it, you probably want to use it too, just as a gauge. And I'm not saying use it purely for trading models, but if you're into trading models, you could do that as well. So for the most part, I thought it would break out and hold, but it looks like we're right back below the 200-day moving average, right? So emerging markets, I do see a bounce trade, but that's all I see. I don't see huge investment opportunities yet. The ones where I do see huge investment opportunities for educational purposes only is in gold, right? So for the past, since November of 2018, that's when we, as a group, where I started talking about gold and how I'm sizing up in gold positions, but not directly in gold commodity. I'm actually invested into gold miners. The main difference is you could buy the actual gold commodity, but the gold miners are a little bit more leverage, or maybe a lot more leverage. But then I'm also doing options on gold miners, so I'm getting a lot of leverage. But that's the only way to make quite a bit of money, right? So for the most part, we could look at our gold portfolio towards the end today. But that's how I feel, guys, about the current market as of this week. Overall, okay, so fundamentals, I'm bearish. Technicals, neutral to bullish. Sentiment, I feel slightly positive. Looking at the volatility index or the volatility futures, I see positivity in that market. Overall, anticipating some major resistance and continuing quantitative tightening pressure of $50 billion per month with less rate lower capability. I know that was like a handful, but overall, I'm gonna re-explain it. Overall, I see a lot of major resistance in the markets right now, right? The USA and over in Europe and Asia. And at the same time, I'm seeing continuing QT, quantitative tightening, which is, for the past, since 2009 until now, the Federal Reserve's been pumping money into the economy, right? Now they're finally taking it out. So that's pressure, that's headwind pressure. You won't see asset prices appreciating. So that's the question, like, is it a good time to, make a big purchase? I can't tell you quite yet, but I think sideways. So the exact number is 50 billion per month. And then the other risk is less rate lower capability. So we're going to talk about interest rates pretty heavily today. We're going to talk about bonds and interest rates in central banks, right? When I say less rate lower capability, that means, well, in 2001 and 2008, when we had those two recessions, and when we were at the peak of the market in 2001, 2008, interest rates were about 5%. It was raised about 5%. And then once the market started going down in 2008, it went from 5% to zero, almost zero, like 0.5%, right? Today, at our peak today, we're at 2.5%. We're half of that, right? They have half the ammo, half the ammunition to fight a recession, right? And so today I want to talk about how, I kind of thought this week, maybe this whole economy stuff is, financially engineered. Who knows? right? I do see new faces, so I'm going to recap on this concept because I think it'll help your understanding for today's session. So for the most part, this is how I view the layers of the economy, right? When you guys operate, you go to a cafe, I always use that example, or go get food, you operate at the, what some people would think the average Joe layer, or the consumer layer. I think I showed this to you already, maybe. No, actually I didn't, I did not show this. So, you can think of it as average Joe, but in my head, I like to think of this layer as the consumer layer, right? And maybe for the other people, I'll add a new concept today. I'll put it right here before. And then right above average Joe, the average Joe transaction, meaning you buy coffee, you buy iPhones, and you buy a car. So at most you'll transact, it's probably like 25,000, right? You go a little bit higher, you get to SMB. SMB would be like you're a Starbucks or a franchise or just any small company that you guys go out to, restaurants and stuff like that. They transact a little bit higher. They could transact up to maybe 50,000 easily, right? Then going a little bit higher, you have mid-market. Mid-market would be like a logistics company or something that with a little bit heavier type of operations. And then a little bit higher than that would be enterprise, right? Enterprise are like the Apple, Google, Facebook. Those are where the deals transact. Those are huge level deals where minimum deal size are like 100K and up. And then at the very highest level is the sovereign level, right? Sovereign level meaning, I always use the example, Prince of Malaysia or the Sovereign Wealth Fund of Saudi Arabia, right? So those are the biggest deals ever. And they deal with commodities and such. So you have to understand that because everyone in here operates in this layer, in some layer in here, right? If you're a real estate agent, you operate in the average Joe or consumer layer. Within the consumer layer, there's ultra high net worth, medium net worth, low net worth. Who are you targeting, right? If you're in the SMB layer, then maybe I'm helping a local, so I'm not a grocery store, but I supply the grocery store, and I'm doing deals between grocery stores. All right, I'm operating at an SMB level. Mid-market, just think a little bit higher, logistics company, or a truck company or whatever. Enterprise, these deals, you're doing deals between Apple and Facebook, right? A sample deal would be like Salesforce buying out MuleSoft, or what's the recent acquisition we could think of? Trying to think of a good enterprise deal as the most recent. I guess.
The two banks that merged together.
Yeah, that'd be categorized as an enterprise deal. So the one I always use, Microsoft acquiring LinkedIn for $26 billion. So that's an example of an enterprise deal going down. At the sovereign layer, can anyone give me an example of a sovereign deal? Sovereign deal would be like, natural gas, oil, or Trump and China right now, the trade war. They're trying to, their drama right there is making huge economic impacts that people don't really see. Now, that's how I think in my head, right? I want you guys to imagine the same thing over here. So this is a new concept for the people who always come by. So the same thing over here to consumer and all that. Deals happen, let me draw this. So there are deals going down every day. Weekend deals would be like a real estate agent or you guys go out and get food. Those are weekend deals, right? Or weekend transactions. When I say deals, it's the same thing as transactions. But sovereigns, I don't think they would transact down here. They would transact basically to other sovereigns and to other enterprises, right? So how do you want to tap into this stuff? You just gotta operate in that layer, right? So let's say enterprises, someone like Apple, they sell to consumer, right? But they do business with other enterprises as well, building out their backend. So maybe something like buying AWS or Microsoft Azure, building out their cloud ecosystem. So that's just something that you want to be aware of moving forward. So I hope this sets up today's discussion, because today's discussion is going to be talking about interest rates, treasuries, and central banks. And most of the time, that conversation is high level. It's up here. It's at the sovereign level. We're talking at the highest level, and that's where the stress is right now. So risk on, risk off environment, a little update on this. Just a few interesting metrics, nothing too much. I know it's kind of heavy on the eyes, but for the most part, I don't see too much risk on. So just look at the first three right here. S&P 500 against bonds. I'm seeing slightly more interest into the stock market than the bond market. But against gold, I see there's still more interest in gold than the stock market. And in real estate, it looks like more interest in real estate than the stock market right now. So before we begin into the discussion, we're going to do a quick market update, right? A closer look at the indices. I know you guys came in earlier, the people came in earlier, we already talked about this, but S&P 500, what I'm seeing, 200-day moving average is acting as resistance. So that's the pink line right here, right? It's acting as major resistance. So moving forward into the next week, I want to continue to monitor that to see if it continues to act as resistance. Because if it does, then, you know, it breaks down this green line right here, the 20-day moving average, then I think we could get an acceleration below the 50-day, and then we'll revisit the 20% decline that we saw back in December, right? So back in December, you look at your portfolio, everyone's 401k was down like 15, 20%. I know you guys know that, because everyone has a 401k, I'm pretty sure. So global macro conditions very uncertain. I can't predict with accuracy. I always tell people I have a very fuzzy crystal ball. And Bernard's always joking like, hey, bring out your crystal ball.
Well, so my overall thought is, let's say you go back in time in December, if you owned stable, profitable companies,
Yeah.
then you could have gone on a 2-month vacation and come back and you're back to where you started from. If you bought fundamentally successful companies,
Yeah.
right? If you bought
Yeah.
flaky ones, then you maybe not the case.
Yeah,
But
true.
you know, so on that curve, that 270 where you're at right now,
Yeah.
it is going to go up or down. So if you load up your portfolio with, you know, companies that are built to last, we'll say, and you spread them around 20 of them, let's say, you'll probably ride out any curve over time.
Yeah, no, that is the case. I mean, I agree with you that strong companies will outperform in you know, tough environments. But that's the same way everything in life, right?
The only problem is that 20% low, retested the new low 2346, it doesn't hold all the way to 1900.
Yeah. So let's look at my S&P 500. For those of you who are new, why do I look at the S&P 500? The S&P 500 is probably a good proxy to the heart of the economy. So if you want to know how well the economy is doing, you always want to look at this chart. This chart is probably the main thing I look at every morning. The moment I wake up, I check my phone. It's not the messages; it's the S&P 500. And you know, some of the theories work really well. So this is the S&P 500, right? I know there's a lot of lines for the new people, but the pink line is the one I want you to pay attention to. The pink line is that what I just said earlier, the 200-day moving average that every institution really pay attention to, right? So you can see that it tested several times on this pink line right here, right? And then it finally broke the pink line over here. And now that pink line, what is previously support becomes resistance. Just something that you learn in technical analysis. So I personally think it's probably going to be resistance at this point, maybe.
Can you explain that again?
Prior support becomes resistance. So
Prior support.
so let's see, what am I saying? So for this case, it's prior support becomes resistance. It could be the other way. Prior resistance becomes support. But let's say the charts are going like this, right? It's hitting its head on this line right here, the red line, right?
Okay.
So this is acting as resistance,
Okay.
right?
It's like a ceiling.
It's a ceiling, right? And then the moment it goes above this, right, it'll probably spike up and then it'll go back down and revisit, but it will act as support now.
Floor.
Yeah, it becomes a floor.
Okay, so can you apply that to the
Yeah.
where we're at now?
So right here I drew support, 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 right? The S, it acted as a floor. Over here it's testing, we don't know. It's in the coming days it's gonna act as resistance probably. Yeah, and if you want a little bit more precision and see like, okay, is it really acting as resistance? Well, I think this chart's a little bit cleaner right here to show you guys rather than the black one. But you see it right there? You see the past trading day?
Yeah.
Yeah. So it just works because everyone else is using it. That's
I
really all
just
it is.
don't understand though how that would explain what took place between December and February. It seems very almost random that if you had that
So
zigzag, that decline, there's almost a
Yeah,
flat line.
yeah. So
right?
December, so December that month, the markets dipped really hard. Now, I think it was around October when we started tightening pretty hard, raising interest rate or talking about raising interest rates. So around October is right here, right? And then things happen after. How do you explain this? I think the market's kind of overreacted from this breakdown. It stretched it down all the way to 20%. And you can see, I drew my 20% line right here, and it touched the 20% and then retraced. So what I said last time is every time we get a 20% dip, the first 20%, maybe you should consider, for educational purposes only, maybe a dip buy, right? But the second 20% dip, if it revisits 20%, I don't know. Maybe. I'll probably trade it, but this one is a higher, the second bounce, I'll go with the first bounce. The second bounce, I think it might break down, maybe.
Is it by history or what when you say that? His statistic or?
Yeah, it's just what I notice when I play
Experience,
market.
right?
Yeah.
So what do you consider as time limit?
Say again? The time limit?
Yeah, when you say between first and second, 1 month, 3 months?
3 years. 3 years.
3 years?
Yeah, so let's say the market, normally 80% of the time, and this is a back test, 75 or 80%, there's actual numbers on that. I think it's more than 80%, like 82%. 82% of the time, the markets go up. And then, let's say 3 years it's going up. That first 20% dip is a first bounce, it's a buy in my opinion. And then after that, it'll try again. But if it fails the second time, I probably think that's a signal to maybe cut back on, start raising your cash levels personally.
Recession.
Maybe, I don't want to say that, but maybe. That's what it seems like. And you guys could go and back test this. How credible is it? Well, this is like 2015 over here, right, or 2016, bounced off right here. You could just back test this, right? So we had a scare in 2015, where I thought 2015 was another year. But, so I'm looking at the pink line, by the way, right? So this year, we're having the same thing. But this year is probably worse than when I saw it in 2015. So this is the 2015 volatility we had in the markets, right? Just look at it visually. Just take a quick snapshot and then look over here and you're like, whoa.
I really don't understand though, that pink line over that last September to current doesn't seem to tell you anything. I mean, that movement went down, up, down, up, down, up, and that pink line stayed relatively flat, so it doesn't really reveal any indication of what's up next.
Yeah, I mean, it's just a gauge of direction, that's all. You don't want to use it to aggressively trade. You could, but to me, I'm just using it to see like where we're at in this roller coaster.
I just put on a link on a weekly S&P chart.
Yeah.
On the chart I can show you.
Are you saying the second 20% we should be kind of selling?
No, I'm not gonna say that. I think you got to come up, with your own
100%
conclusions.
cash.
You got to come up with your own conclusions on that.
Looking at the S&P weekly chart, anytime
It's
we go
amazing
below
cash.
this 50 MA, which is the blue line, and we break really aggressively below it, usually we stop at the red line, which is the 200 moving average. So that big swoop down, we stop right at the 200.
Yeah.
And then we retrace it right back up to the 50 MA, which is the blue line. I put a little blue square there. And then from there, which I think we should break down and retest. But and the reason I say that is because from previous markets that didn't like this, like in 1929, 73, 2001, 2007, it always did that. It went to the 200 MA, right back to the 50, and from the 50, we're lower.
Yeah.
So as long as we're below that 50 MA on the weekly, it's very bad news.
Yeah, so I noticed that the 50 MA on the weekly is almost the same as the 200 MA on the
It's a little
daily.
different, but it just acts like a huge wall.
Yeah, so this is just JC likes to look at a weekly chart. To me, yeah, you can switch around. I think looking at both is very important. So anyways, hitting resistance at the 200-day moving average and prices are above the objective trend line, which is right here, right? So the top side. So it's slightly above, which is okay. I think there's a chance for the markets to work its way above the 200-day moving average for a fake out. The interest rate environment is significantly different from 2008, and we'll get into that in a bit. For the NASDAQ, same thing, right? Resistance at the 200-day moving average, but Dow Jones above it, acting as support now, right? And then small cap, IWM, having trouble at the 100-day moving average. So that's what I'm seeing. For the wave theory, right? For those of you who want to look into more advanced technical analysis, the wave theorist, Tony Caldero. I won't go to his website, but I'll leave it right here. From the looks of his blog, he's starting to turn bullish. He's seeing long-term uptrend with 80% probability right now.
What does that mean long-term?
Long-term is probably 1 year and above. Medium-term is probably up to 6 months. And then short-term is probably a few months. So he's seeing that, there's uptrend probability, at least according to his methodology, which is he's using wave theory, right? We won't go too deep into that because I don't know if I have enough time. I did want to do a quick gold update, right? So this week, if you're watching gold, you're probably like, gold didn't really perform. But, gold didn't perform this week, or did it? You'd be surprised. If you knew how to analyze the financial markets, gold did really well this week. Why? Because the dollar rallied. The dollar rallied and gold didn't go down that much. Usually when the dollar rallies, this is a bullish divergence, right? So if you take a look at the chart below, this is the dollar right here. I know we're looking at it's very tiny. I'll zoom in. So I continue to have positions in gold, but this is what we're seeing. So USD, this is the dollar index or the dollar futures. The dollar rallied this week, right? The past 1, 2, 3, 4, 5 trading days, right? And what happened to gold? Gold didn't go down that much. So usually when we have something like that, I would expect gold to go down further. But this is telling me that there's some buying activity here in gold. So I'll continue to monitor that. Last week we said, I probably feel that central banks have called the bottom in gold. Maybe. And there's substantial upside because we might go to QE4, which just means we're going to print more money. And then asset prices are going to increase like crazy. But anyways, that's the quick analysis on gold. Hey, Santo. So let's go to the next part. So anyways, you guys have any questions? We're going to get started on the bond market stuff today.
Usually gold go up and stock would go down, but right now it's gold also go up and stock also go up. It seems like.
Yeah.
It didn't seem to make
Exactly.
sense.
That's the exact observation I believe 2 weeks ago when central banks. I know I keep talking about central banks, but the game has escalated to this point where they wield the most influence. It seems like, and what they say kind of determines where all other markets go. But today we're going to talk about this huge wealth inequality that's kind of occurring. There's a huge gap. Okay, and I tell you guys this because I look at real estate prices of some profiles, and they bought their home in 2013, and 5 years later, 2018, it appreciated 600, 700,000. That's insane. And you're thinking you buy it now, it will appreciate another 500,000? Maybe if we start doing quantitative easing. You have any insights on that? Or your take?
I just read that appreciation will be
More nerfed or?
5 or 6%.
Mm-hmm. Yeah, for the most part, I think it will beat inflation. So you're right, maybe 5%, something like that. I personally feel that, well, I don't know. We'll analyze it. So let's get started. Bond market and bond yield observation. So today is going to be, we're going to talk about bonds. Do you guys know what bonds are? You guys okay with that so far?
Yeah.
Because I know we got some new faces in here. So basically there's risk assets like stocks and then more safe assets like bonds. And when we talk about, let's say you want to buy a home, right? And you got to look at the mortgage rates. The mortgage rates are based off of the bond interest rates. So there's two ways of looking at it. Are you looking at the mortgage rates, which are like 4.1%? Or are you looking at the bond rates, which are like a lot lower, like 3.75, something like that? All right, or 2.5% for this one. However they move that interest rates, it kind of influences the economy. And so that's what we're going to analyze today. So historical bond yields, same as interest rates. When I say bond yields, I'm talking about interest rates. So just kind of get the difference on that, or the similarities. It's just another way of saying it. At the peak of, so the analysis that I came upon was this. So in 2001, guys, I guess I should give a little bit of intro for what I'm looking at. This right here is the dynamic yield curve. And I was doing a little bit of analysis over the weekend, or over the week. Let's see, focus. So Guru Focus is another tool that I use. I don't recommend this because it's extremely technical. They give you 30 years of data, and it's pretty expensive. So if you're gonna pay, you really want to use it, right? But in here they have something called the, well, I should show you the simple one, dynamic yield curve. This is the easier one because this is the harder one. So there's something called the yield curve, right? And the yield curve basically is like the volatility futures curve, which most of you probably know, or the older members know already. But this is the easier version of the bond yield curve, right? And basically on the right side, I'll draw it out. On the right side right here, this side is the S&P 500, right? This side is the yield curve. And in the yield curve, there's the 3-month, the 2-year, the 5-year, the 7-year, the 10-year, the 20-year, and the 30-year, right? Each are different contracts that together, if you put them together in a line like this, you track the prices and how they move. It creates a curve, right? And typically the curve is like this, right? And we study, as financial people, we study how this curve moves. If the curve is inverted like this, it's telling something about the economy, right? And so, a lot of money managers like to and use it to kind of predict the next recession. So I'm gonna play this, and it's gonna go by, and you're gonna see how the yield curve reacts. So typically at a peak, right? At a peak, it will invert, meaning at the peak, it'll go like this, right? When it goes like this, following that, the S&P 500 markets, or the stock market, we go into a recession after that. This occurs 83% of the time, if you were to back test it. So every time they raise interest rates, then markets tend to deflate, right? So pay attention to this formation, or sometimes even this formation. This formation to me is, it's not really a good signal, but it's kind of like, okay, maybe it wants to go up. But anyways, so this is on the right again, S&P 500, 2001, 2008, and then today, right? So let's play it. Where's the play button? Okay, I guess I'll move it myself. So 2001, we know we had a recession in 2001. What happened? Look at the yield curve, right? The moment it inverts right there. So now it's inverted, right? What happened after right here? Recession, right? Now let's go to 2008. We have it inverted right here, 2008. Stays inverted, stays inverted.
Change direction.
This thing's inverted, right? And then following that, recession, right? And in a recession, we lower interest rates like crazy to juice the economy. And that's why I'm saying in 2001, my analysis is that 2001, 2008, interest rates were at about 5-6%. Today, it's at 2.5%. So they have half the ammunition that they had the last two recessions. So we have a recession today. It's going to be pretty painful. It's what I observed. So let's look at today. So after we have a recession, interest rates go all the way down to like 0, right, for a very long time. And it stays at 0, 0, 0, 0. What happens when it's at 0? They're pumping money into the system. So stock market rises. Real estate prices rises, right? So all the way, 0, 0, 0, 0, 0, 0, 0. Now it's starting to rise right here, right? And then just recently, this is where we're at. It's a little bit of an inversion. But they're not at 5% where they probably like to be. They're about 2.3%. So I see it as they. So this is where you see it, right? As they raise the interest rates, we all feel it in our 401ks.
So what's in the, on the red?
This one?
Yeah. So
Yeah.
what's on the right hand side? That's the 30-year, right, interest rate.
Yeah, this is the 30-year. So I'm going to flip over to the more technical looking chart. We're looking at the same thing. This was the basic. We're going to look at a little bit the paid version, I guess. Well, I took pictures over here, so let's go over here. So at the peak, so what I have right here is 2001. Follow the yellow line. As I move the yellow line, that's where the current time is, right? So at the peak of 2001, this is the peak of the S&P 500, right? And this is the yield curve at 2000. And
So definition of yield curve is?
Interest rates. Definition of yield curve is the entire curve tracks the bond market contracts. So there's like the 30-year, 20-year, 10-year, 5-year, 2-year, whatever.
Mm-hmm.
It tracks that whole thing. So you're looking at the entire market with just a curve. Versus like, okay, so let's say if I go back and I want to analyze the bond market, there's an old-fashioned way of just doing this right here. It's like, I wonder where interest rates are at. I'll look at the 30-year, right? Now I'm looking at the 30-year, and then I'll flip over to the 10-year, right? And then I'll flip over to the 5-year. But that's very tedious. You could do that if you're a bond trader. But if you want more precision or a quick and easy way to analyze it, just look at the curve, right? The curve is like right here.
So what does it define? How is it?
Yeah. So this is where you probably have to read a little bit on it offline. But basically, if the front is backwardated, they call it. If it's pointing up, then this.
I understand.
Oh, okay. You understand part.
My point is, how do they? So let's take this first point, right?
Yeah.
So it is between 6 and 7%.
Okay.
And the 30-year.
Oh, sorry. So we're looking at the yield curve currently in 2000, right? The yellow line.
Right.
At the peak of the market in 2000, and the current yield curve is saying 6%.
Right.
So central banks have 6% to 0% to inflate the economy or hold it up.
And in the same chart, 30-year is around 6%, a little less than 6%.
Yes, correct.
So, but when you move stuff around, I understand the left-hand side going up and down, but you're just saying that 30 years ago, the same point is moving up and down.
Could you repeat that real quick?
So when you move the curve around.
Yeah, yeah.
Right?
No, I'm not moving the curve.
No,
It's
you're not
all
moving the
historical prices.
When you go from here to here, right, when you
Yeah.
shift,
Yeah,
this moved, I understand
yeah,
that.
yeah.
But this also moved,
Yeah, the whole curve moves.
Yeah. It's the longest
because this
part
is
of it.
30 years ago,
No, this is a
No,
30 year,
yes,
it's
no,
a 30-year
30 years
yield.
later.
30
It's a 30-year yield.
Yeah, it's not 30
20
years ago, it's a
yeah.
30-year contract,
Oh,
right?
yeah, different
So,
price.
so let's say the government,
Okay.
right, when the government issues bonds,
right,
so we know that the government, we pay taxes, right?
right.
So it's like 50% if you add it all up, sales tax, capital gains tax, whatever transaction tax, right? But when we have a budget deficit, they don't have enough money, what do? They issue contracts called treasuries on our behalf,
Right.
because we're paying it later. It's like, oh, I can't take more than 50% from your income. That's okay, man. I'm gonna lend on your behalf.
Okay.
So that's kind of what's happening on the
I
back
understood
end.
what he said.
Yeah. So they'll lend out a 30-year contract, a 20-year contract, and they'll ladder it so that it's a portfolio for them, right?
Okay, adding to your point about how
Yeah.
much ammunition the Fed has, I put in a link where what the Fed did in the last two bear markets. So it kind of told you what happens when they get really worried about the economy. So you
Yeah.
can see what's going on. But in the 2001 scenario, it doesn't have my markings, but
I'm looking at S&P 500 again.
yeah, no, it doesn't have my markings because it's not a paid membership or whatever. But basically what they did is all the way down, they decreased the rate 1, 2, 3, 4, 5, 6, 7, 8, 9, about 14 times on the 2001. And on the going down in 2008, they decreased it 1, 2, 3, 4, 5, 6, 7, 8, 9, 15 times, at a quarter,
Yeah.
all the way down.
So
And like you said, ammunition now, they only have so much, to lower.
yeah, that chart is kind of hard to see.
Yeah.
I think you might need like a,
Yeah, I have it up here.
an
if you want
annotation.
to,
Yeah. So you had a question?
Is the QE the same thing as lower interest rate?
No, because they control the rate,
Okay,
but they also control the money supply.
okay.
So QE and QT is the direct control of the money supply. But interest rate, that's part of their monetary policy. In other words, if I were to put it in like layman words, it's like their power to move the money supply and the rate of borrowing or trading the money supply, if that makes sense. So they control that, but
In the past 30 years, have we ever do QE, this kind of similar thing?
yeah.
Past
So
30
you're kind of skipping ahead already, and I like that. We'll take a look at this chart. This chart kind of gives you what it looks like. So I wanted to show this chart first to show that this is the current balance sheet of the central banks, right? Because that's important. If their balance sheet is bigger, that means they acquire a lot of treasuries. When they buy treasuries, they deploy money into the economy, right? So as of most recent, they're trying to reduce by 10%. But you're asking about the QE. This is what the QE looks like. So in 2008, when we had the recession, right? So they started buying up treasuries right here. And then QE1 bought more treasuries. QE2 bought more treasuries. I don't know what happened over here, but it just kind of went sideways.
Twist.
They probably, just played with the markets, whatever happened. And then QE3. And then as of late, we haven't had any QE. We've been having QT. We need to reduce their balance sheet because it becomes higher risks at this point. Because again, you're paying 50% in taxes, and they're borrowing on your behalf. But how long can they keep this going, right? If they keep inflating it, we're going to talk about wealth inequality today, which is so critical because it's a new form of risk that I'm starting to see, right? Before we've been talking about like, okay, global macro risk, indices across the world are kind of pointing down, sovereign risk, their balance sheets are all inflated. But today I want to talk about the wealth inequality risk, where if the wealth gap expands too far, there's going to be social chaos, right? And I don't think, politicians want that. So there's incentive for, to go for a recession or to have social chaos. So in a sense where it's like, wow, this game might be really engineered. It's artificially engineered. But I'll show you some evidence.
We have a really bad stock market about on 73 and 29. Do we have a QE back then?
No.
I mean, is it something
No,
new?
there's the first time I've ever done was 2008.
Oh, okay.
There's
So the first time ever in kind of like a
100 years.
100 years.
I mean, I don't have beyond so the central banks themselves, right? The Federal Reserve, this is the most data they have. I don't have 2001. If I had 2001, that'd be awesome. But my thinking is that they've slowly increased the borrowing because it's all based off what the government needs, right? The situation right now, the government is about 21 trillion in debt. And every time they issue a contract, their debt goes up, central bank assets go up. So it would look like this because you're negative, right? But debt goes up, assets go up. how much further, so when you see the government accumulating more debt, because they're borrowing on your behalf, right? They're issuing more treasuries. So the central banks are going up.
So US stock is, right, the QE thing, it's pretty much US started, right? Back
Now,
on 2008?
you know, I wouldn't say, so QE, I wouldn't say it's US started. It's since the beginning of empires. So, yeah, really. This guy's being entertained over there. It's since the beginning of empires. I haven't read too much in Roman Empire.
In the world did it, but they never.
Yeah, I think to be honest, if you're a history major, you would really know this stuff pretty well. I'm not a history major, but every empire, right? Just you're a king.
Oh, okay.
Today you're a king.
Yeah, back on those Roman
Yeah.
days, whatever.
Yeah, to finance your war, you're going to dilute the gold
Okay.
by putting metal, molding metal into it,
Yeah.
and then saying like, you guys, this is the gold, man, but it looks a little bit different. It's the same. It's the same form of QE. Hello, right? But the beauty of gold is that it's been man's obsession for 6,000 years. So to me, it's like, man, if we fought and died for gold, and if modern day monetary architecture or policy is devaluing the dollar, and that's how real estate prices go up and stock prices go up, maybe I should go buy gold, right? And if they decide to repeg to gold, because we're a fiat currency, we're not pegged to gold. We're pegged to because they say so, because they got the military. So if they decide to go back to gold, well, hey, I have a position in gold. And we saw this year, in the past year or two, we saw China and Russia accumulate gold like never before. But the economy that has the most gold in the world is the USA, about 8,000 tons, right? And in Russia and China, it's like 2,500 tons. We have those numbers, but we're not talking about that today. But I can see you like the topic. Yeah, pretty interesting stuff. So going back to the, did you guys have any questions before I go back to the yield curve stuff?
I have a question.
Yeah.
What happens in the event of zero interest rates to the US dollar?
Yeah, so financial books talk about that. When we go zero, right? There is zero and then inflation too, so it'd be negative. The real will be negative, right? So let's say nominal interest rate, they call it. So the spot or what is showing is 0%, but inflation is 2%. Then the real interest rate is minus 2%, right? So what would happen would be if it goes negative enough, like let's say negative 5%, then there's a spread between 0 and 5%. So private entities will jump into this market and say, don't put it with the banks, put it with us, we'll pay you. Because there's a spread on it. Or we won't pay you, but we'll take less. Instead of losing 5% every year, you're losing 3%. So there's economic incentive to kind of jump into, to capitalize on that spread, right? I know that thinking is kind of hard to think about, but an example I use would be like modern day education. And I talk about this all the time, is, parents are paying for college tuition that got inflated to overvalue, but the knowledge quality is lagged, right? I joke with Aaron saying like, dude, my finance degree at San Jose State is a financial history degree. Because it's been it's outdated, but it's been inflated in value. But when we inflate something like that, do the professors get better at teaching? Not really, man. It's just this, so what happens on the backside is we got expensive education and low quality, right? And then you see the VCs, the venture capitalists, they're investing into private education where knowledge is high, cost is low.
It's a good market.
It's a good market, man. There's money to be made. Yeah, like that's how you recognize economic opportunities. So these days, when I'm looking at investment opportunities or business opportunities, I want to do a critical analysis of the market, right? How many not just that analysis I just told you, but also which other competitors are already taking that market share. So I see a lot of VC venture capital investment into like stuff like Uber or platform software models, right? They're not making money yet, but they want to be the first to market, first mover advantage. So just some interesting insights. Yeah. Did that answer the question? But about the negative rates or zero rates?
Yeah.
At zero rates.
Wait, my question is really like, is the US dollar going to go up, go down, or get deflated?
So in a global,
And
yeah.
If you're like in America, would it make more sense to invest outside of America in that event, or would it be?
Yeah. So when you ask me where the direction of the dollar is going, let me get back to the whole sovereign layer. You're asking me the highest level question possible, right? And I can't be the representative to answer a multi-trillion-dollar question, right? Just to kind of tell you like the economics of that question. Do I think the dollar is going up? It's all about time frame, right? Maybe in the short, midterm, or maybe slight long term, it's going to go up because of global fear. So Jim Rogers is betting on that trade. Jim Rogers is a commodities guy or a global macro guy who used to work with George Soros at the Quantum Fund. He's betting on long dollar.
When?
Because,
When do you?
right now. He has an active trade, if I recall. Santo, you remember? I mean, Santo went to the event and spoke with the guy on stage. So he's long the dollar, and I understand his thesis because the initial fear when interest rates rises, dollar becomes more attractive. So people run to the dollar. If they run to the dollar, then it hurts the emerging markets. If it hurts the emerging markets, then emerging market money managers jump out of emerging markets and go to the dollar. So and then George Soros in his book Alchemy of Finance, he says the dollar begets the dollar. A stronger dollar makes the dollar even stronger. So and if the dollar goes up with higher interest rates, that's a double whammy on the economy, right? Because it's more pressure. If the dollar goes up, it's more pressure on the economy and also the interest rates. Because interest rate example would be, well, if the dollar goes up, dollar versus real estate. If the dollar is higher, how can the real estate price be higher? That's the dollar side. Now, interest rate side. If interest rates go up and the price is really high, how much can you borrow? Your borrowing power goes down. So it's a double whammy on the economy. That's just real estate. You got to think about corporations who are borrowing money as well.
Also, as far as currencies go, the U.S. dollar, even though it's not respected and so forth, is the best currency in the world. So when the euro starts to go down and people get out of the euro, they're going to go to the dollar.
Yeah.
So it's like the cleanest shirt, and
Yeah.
it's not good, but it's the best there is as far as currency goes.
Yeah. So
any kind of danger in the world, they're all going to the dollar. So in my opinion, the dollar is going to go higher because of that. Even though it shouldn't be, it's just the best of the worst currencies. And when the euro, I think, is going to go down, and then they're all going to go to the dollar.
Yeah. So studying global macro and understanding all this, it really made me proud to be, earning a dollar versus like another currency, right? But that's where I see the path of the dollar. I think the dollar will rally. If the dollar rallies, it's going to hurt gold. But the bullish divergence I want to see is the dollar rally and gold rally. That's when I know, like, okay, there's some serious fear right now when those two major asset classes are rallying. Because the game has escalated to a global macro level. Anyways, going back to the yield stuff. So at the peak of 2001, bond yields were about 6%. And following the recession, bond yields came down to 1%, right? So this is before the recession, and then this is after recession, right? So before recession, they had 6%. They raised it to 6%. Curve inverted. And then below, you see this is the top of the market. And then over here is the bottom of the market. What happened at the bottom of the market? Bottom of the market, they lowered it all the way down to 1. Just interesting insights to back test a recession, right? And use that historical price action to gauge where we are currently. Let's look at 2008. Same thing I'm going to draw. At the peak of 2008, bond yields were at about 5%. And following the Great Recession, bond yields came down to almost 0, right? The last one was down to 1. And then so 2008 went down to 0. It was that bad, right? On top of that, it went down to 0. Also, QE came in. Because it didn't look like we had QE in 2001. So now we're at 2.5%, and we got QT. Damn. Yeah, that's where it's a little scary right now. At the peak of 2008, bond yields were about 5%. Oh, I read already. So this is what it looks like, 5%. Peak of 2008, kind of the peak. I think I could move it a little bit right. But what happened after that? The bottom of the market, interest rate down to like near 0. I think it was like 0.25 or something. Insane, right? So it's not an easy game they're playing. I wouldn't want that stress, man. Yeah, I'll stick to being an investor or a capitalist. I like the realm I play in, which is like software, technology, and the real estate stuff. But that's what it looks like, 2008. Any questions on that? A little cool, some cool charts and insights, nothing too much. You want to take the whole picture if you can?
The future looks more negative interest rate or more QE?
The future, so this is why the wording of the central banks has been so important that, what they said recently 2 weeks ago, it caused gold to rally and stocks to rally. That's kind of weird, right? So it wasn't clear. They gave a lot of uncertainty. So I think it favors right now with the 20% decline. The Federal Reserve are playing the markets too. That's why I came to the conclusion. Historically, they never admit that, but as of most recently this year, unprecedented, they're starting to admit that they're playing with the markets. So this tells me moving forward, like, hey, I'm really, this is some good education right here, right? Because if they're really playing the markets. So
The government is paying the market?
I wouldn't say the government because
The
the
central
central banks,
Yeah.
but like they operate like partners, like business partners. You know, you got your channel partners. If you're into like corporate, corporate lingo, hit up the channel partners and see what they're doing. Yo, central banks. Anyways, because in business, right? You want to. This is like this little bit of business 101. Whatever business you get in, whether it be corporations or a real estate agent business, you got your partner ecosystem. My partner ecosystem would probably be like insurance agents, loan agents, right? Mortgage lending and all that, or real estate investors or whatever, right? But then my business would be consumers of real estate, right? But at the corporate level, let's say you're a software company, your partner might, let's say you're an independent software company like Twilio, your partner might be Salesforce, and Salesforce owns like 1% of Twilio. So, yeah, interesting stuff. There's repeated patterns at different levels. So looking at 2001 and looking at 2008, how about 2019? How about today? What does it look like today? So central banks do not have the luxury, again, guys, of 5% bond yield that they have in 2008. They had 5% right here to lower it down to 0. And in 2001, they had about 6%. They had a lot more back then. Now, this is why I'm saying that over time, you hear me say this before, is that the monetary architecture is really decaying. It's decaying to a point where, let's say we go to the next cycle. It goes 0%. Next cycle, they raise it to 1.25, right? The next 2008, interest rates are at 1.25. They don't have much ammunition, right? So it's telling me that QE is going to be permanent, because once you exhaust your first tool, which is interest rates, right? Before it was 5. Before it used to be 10%. They lowered it to 5%. Now it's 5%, they lower it to 0%, and then now it's 2.5%, you're going to 0%, and then the next wave is going to be 1.5% and 0%, and over time it's going to be 0 to 0%, or 0 to -%. So that tells me that the monetary architecture is decaying, right? And this is why I'm personally bullish on Bitcoin, but that's for educational purposes only.
Why Bitcoin? Why not something physical like real estate, for example?
Something, so you missed the first part today. I was showing off, like, last week we talked about China's economy, the digital economy. The next wave of demographics are very highly digitally native. They might transact, like there's more mobile phones out there than bank accounts, right? And today the modern day oil chase is actually the modern day data chase. And I think you would probably know that the best because you're kind of building out the infrastructure, right? Damn, I forgot your question. What was your question?
Yeah, so when you talk about inflation.
Oh, right, yeah.
What inflationary assets would make for a good hedge
Right.
against inflation?
So Bitcoin is more of a venture capital fixed asset, right? I'm only going to play it if everyone else is playing it. And so I see Bloomberg, showing like the S&P 500, Dow Jones, NASDAQ, the VIX, and then Bitcoin prices. So they're creating this culture, and this Bitcoin is like a global culture thing. I know it's like in a bubble. It wasn't a bubble. It popped. But it's still higher than its previous price level, is what I'm analyzing.
So let me rephrase my question.
Yeah.
So if you backtrack to previous inflation periods, was the stock market able to track and grow with inflation? Is the stock market historically an inflation-resistant asset if you're investing in the stock market?
Yes. By financial textbooks, the answer is yes. And I'm answering based off that reference. But if you want to backtest it yourself, I haven't done the backtest, so I don't know.
But if you assume that we are a consumer-oriented economy,
Yeah.
inflation reduces your buying power,
Yeah.
then that leads into declining earnings, that should lead to declining stock market.
A quick thing on inflation. Usually the inflation and the stock market go together. One exception is the 1970s when inflation took over and the growth was not there and it went the other way and the stock market just crashes, inflation kept going higher. So we have history when they divert. For the most part, they kind of go together a little, except for the big exception.
Could you repeat what you said again?
Yeah, just wondering, based on everything you're saying,
Yeah.
what kind of asset classes make sense to invest? If the long
We
term
don't
is
know,
gonna
just
be-
diversify.
So
That's
so
my
I gold, and the way I view that is, so let's say we have inflation, right? Inflation is going up. It should cause all asset prices to go up. So real estate, stocks, and bonds, right? But it's the relative growth of that. Stocks have went like this. When yes, there's inflation, but stocks went like this because the system got so tight that there's nowhere else to invest. You get what I'm saying? Like everyone, like if you read financial reports and stuff, they talk about how, the stock market is becoming the bond market because there's nowhere else to hide the money. Not hide the money, but store the money, right? If bonds are not paying you anything,
Yeah.
it's at all-time highs. You see what I mean? Like the game is really decaying and is shifting over to another game. And so if I were to speculate or forecast the future, it seems like Bitcoin might be that type of infrastructure. It won't be actively traded because it has like a lot of infrastructure issues, right? But I think it's going to be something that people base the asset off of. And so last week we talked about the many theses of Bitcoin, right? From sovereign risk, how there's just the monetary risk, the monetary system is decaying, so reason for a new currency, I don't know, right? But I'm more on gold than Bitcoin. The demographic risk, what upsides do millennials have, right? I forgot all the risks that we talk about. The technology risks, right? Technology is advancing, or technology efficiency, investment thesis.
Sorry, I was going to ask, what is a good way of diversifying in the Bitcoin cryptocurrency realm?
I don't want to be an advisor on that, but like to diversify into
So
it.
don't just buy one type of coin.
So
Because it's speculative.
it's speculative, and I wouldn't use more branded names right now. And people, in the gold chase, the people who profit the most were the ones who developed the infrastructure, right? That today, the equivalent is Coinbase, because Coinbase actually has real venture capital funding from people like Andreessen Horowitz. So that would be where my initial access would be, and I would probably store the initial trust there. But I wouldn't allocate all your. If you're a big bettor, that's up to you. But that's just my take. I'm bullish on gold, and Bitcoin just seems to be the digital gold. That's all. But I don't know if I answered your question in terms of like how I view it. Like there's many different layers of risk. There is one major risk with Bitcoin, which is USA saying, it's illegal to hold Bitcoin. That's the major risk right there.
So ignoring Bitcoin, my question is, ex-Bitcoin, right? Because there are some that will
Yeah.
assume that Bitcoin is a scam because, what if tomorrow you have a derivative that comes out
Yeah.
that mimics Bitcoin, you have a second and third and fourth Bitcoin.
Yeah.
So if you ignore Bitcoin,
Yeah.
right, take Bitcoin out of your answer.
Yeah.
Versus stock and real estate or gold commodities.
Yeah.
What do you think is the sort of asset classes that make sense given the trends that you've seen in terms of inflationary?
Yeah. So for sure, anything real and fixed, so real estate. Now, which one's cheaper, real estate or gold? Gold, right? I'm saying they're all good, but relatively one is cheaper. And I'll draw the chart for you. So let's say inflation's at like 2% like this, right? 2%. And at the same time, what's happening in the economics of the game? Let's say the next line I draw is the stock market, right? The red line's the inflation, right? Stock market went like this, right? At the same time, there's inflation. Let's see what happened to gold. I'll draw gold right here. Let's do black for gold. Should be oil. This is what happened to gold. You see what I mean? Let's do real estate as well. Might as well finish the picture. Real estate will be, let's do green. This is what happened to real estate as well. You see what I mean? So, yes, further inflation would make those two asset prices go up, but gold hasn't been performing as much as the other ones. And so I'm just saying the rubber band effect, that there's just too much. Like, people didn't run to gold; they ran to like stocks and stuff. So there's a extension over there. If that makes sense.
When you look at Guru Focus, because I know you look at Guru Focus,
Yeah.
do you see the gurus buying gold? Are you seeing any of the?
Yeah.
They are?
Yeah. So we talked about that extensively. The biggest one, Jim Simons. Man, I'll tell you a story about that one. Maybe offline. I actually reached out to the company Kinross Gold Corporation, I reached out to the CEO, CFO this week, and I sent an email that turned heads, but I'll talk about that offline. Basically, I said, little teaser. I said, like, your company, what did I say? I said, like, Jim Simons owns 55 million shares of your company. That's about 95%, and I think your company is in a position to capitalize on the, economic opportunity ahead. And blah blah blah, this and that, and it got them to turn heads. They gave me a call, but more on that later or offline. So that's what I see with the markets. It's you're right. Inflation. I mean, is that what you're saying? Inflation would cause prices to go up, right? Like stocks and real estate. But because no one has historically put it in gold, that one's kind of like the underperformer that needs to perform. And so when the global macro risk arises, there's a huge thing for that right now. So that's where I see the most upside. The next upside would probably be Bitcoin, maybe. That's only if we socially accept that, right? Like sometimes we do, I think humans do the weirdest things, but I don't know, because I know you probably understand the technology way better than anyone in this room.
Yeah, I'm not a big
Yeah,
fan of Bitcoin.
yeah.
I feel like, what's to prevent more derivatives of Bitcoin from coming up, or more
Yeah.
folks in Bitcoin?
Yeah.
Those things just,
Yeah.
one fork, and then all of a sudden this credibility question.
Yeah, so I would stick with real estate and probably gold at this point, and bonds.
Bitcoin
But bonds are decaying too, because they can't keep issuing bonds like this on our behalf.
But Bitcoin doesn't sleep either. It's constantly trading, right? So when an article comes out about a Canadian crypto exchange, Quadrica, says they cannot repay most of the 190 million in client holdings because the CEO was the only person who had the password and is dead. So what do you do if you're an investor and you bought into that? There's no regulation, there's no one to go after, there's nothing you can do.
Hey.
So just buyer beware. I mean,
I'll tell you this. Every new technology is debated, right?
yeah,
If you came to my technical discussion number 1,
right.
it'd be 3 guys at Starbucks. You'd be like, it's not going anywhere.
I'm just saying.
I think as the infrastructure develops over time, I don't know, man. That's kind of my take on it.
I'm just saying, in putting money into Bitcoin is not investing; it's gambling at this point. You're just so don't put 100% of your portfolio in it. If you
I
put
wouldn't.
5% and just sort of see what happens and have some fun with it, but don't bet the house on something that could go to 0 or it could go back up to 20,000. But you're talking incredibly high risk.
So I mean, I think. So the many themes, right, that we talk about why be bullish for Bitcoin, I really feel the demographics is pretty strong. Like millennials right now, you think millennials could go out there with max student debt, like unprecedented student debt? They can't buy homes, right, or maybe even a car. To buy a home at $1 million, right? If not homes, then can they buy stocks at all-time highs? Right? Bonds are at all-time highs too. So. How do millennials have that wealth building effect? And that's going to segue into what we're going to talk about today.
I'd still say this is the biggest pyramid scheme in the history of the world that took place. And just remember, for every dollar that gets made on Bitcoin, someone loses $1, okay? There's a natural balancing. So for everyone who bought in 2017 and cashed out, fantastic. But for everyone who bought at 2018 and lost 90%, they're down 90% and probably will never get it back.
Yeah.
So that chart just speaks for itself.
Yeah. So I'm gonna side the guys who have the big funds backing up this infrastructure, right? So like guys like Pantera Capital or what's his name, Tim Draper. Right? These guys are crazily invested into Bitcoin. I don't know. I like to play the social part, but I'm not gonna debate with anyone. Let's list it out objectively. These are, the efficiency gains, and these are the negatives and all that, and see what happens. At the end of the day, I'm more of the traditional investing or alternative investing, which is like private equity. I rather invest in an entity that organically makes money, right? So that's my sweet spot. There's gonna be stocks like Twilio, MongoDB, I don't know, Salesforce, Splunk. They're gonna come back.
Elastic.
Rapid7. Elastic's a new one? What's that one?
Elastic.
Is that a public one?
Yeah, just
Shut.
ESPC.
ES what?
PC.
ESPC. So.
T as in Tom.
Oh.
What do they do?
search company,
Is it?
database and search.
Ooh, ESTC. Okay, all right. Maybe I'll look into this.
Like you-
Let's see their private
Founder
transaction.
doubled his wealth he's a billionaire already.
Yeah, that's how you get rich, man. Elastic NV. So let's look at the private market transaction real quick. Elastic NV. Oh, this company.
Yeah, but IPO, you're afraid.
IPO is typically overvalued. Yeah, you,
Yeah, this is a great company. I would be buying this.
Oh, just small position.
maybe we could analyze it next week. 162 million in
If you miss
pre-funding.
MongoDB, you miss Splunk, you don't want to miss this.
Oh, I don't think Splunk and MongoDB are done yet. I think they have substantial upside
That's what I'm
still.
saying. This is
Educational purposes only, okay, guys? Yeah, I'm not trying to recommend. Yeah, so Benchmark, Index Ventures, New Enterprise Associates. These are pretty good VC firms. They're here in Mountain View, right? That's the thing, man. That's the thing I love about Silicon Valley. Nowhere else in the world. Well, okay, I shouldn't say that. That's too ignorant. Only other few places in the world where you have this high quality engagement, right? You won't find this in the Midwest. You won't find anyone that you could talk technology with. You won't find anyone who could, debate Bitcoin with you. You probably only find like 90% side. Here you might find 50-50. Who knows? 60-40 maybe. There's a lot of high quality people here in the Bay Area, and that's
real estate always goes up.
it's why what?
Real estate is always goes up.
Yeah, real estate will go up. Again, I said we saw 36%,
It will
40%.
go up long term, but not as fast as before.
Yep.
Yeah.
Yep. So 36% to 40% decline in Apple, but Santa Clara home prices went sideways.
And another
Amazing.
10 companies are going to go public this year.
Yeah.
So that's another
Yeah.
500 potential millionaires
Yeah.
who can scoop up half the real estate
Yeah,
in
man.
the Bay Area.
Yeah,
so
crazy,
there's
right?
not
And then-
another 1,000
and then-
houses being built tomorrow.
The other thing too is for commercial real estate, let's say
Right.
millennials can't buy a home. What are they gonna do? Rent.
Right.
Right? They're forced to rent. So if they're forced to rent, multifamily might be
Absolutely.
I don't forecast that much of a decline. I know cap rates are low. It could rise, but
Yeah, yeah.
anyways, let's kind of finish the document right here. So what does it look like today, guys? Central banks do not have that luxury. All right, we already talked about that. But wait, there's more. In 2019, we have quantitative tightening plus rising interest rates, which is currently at 2.5%. So they have a lot less ammunition in a very pumped up market across the board. You ask me where prices are going, I can't even tell you. It's just, that's the $1 trillion question, right? If a recession were to occur, central banks have less monetary policy to support the economy. I already said all that. Versus 5% back then, where they also had quantitative easing in 2001 and 2008, right? This time they're doing quantitative tightening. They didn't do quantitative tightening in 2001, 2008. Isn't that interesting?
That's fascinating.
Right? That's kind of scary. So I don't know. I think the more I read this, well, I wrote this myself. The more I reread this, gold seems to be that fixed asset or commercial real estate. It just seems really, But again, we look at the central bank financial stability report. They said the markets that they feel are overvalued are number 1, stock market, number 2, commercial real estate. Residential real estate, and then number 3 was commercial real estate. Right? And it's funny because it seems to follow like the simplicity of how to invest in it. Right? Where, commercial real estate makes sense to be number 3 because most people would jump into residential real estate before they go into CRE. Stocks are a little easier to access. So this is the Fed balance sheet today, guys. They successfully brought it down 10%, right? From 4.5 trillion to about 4 trillion. That's something that I'm tracking every now and then, maybe like a monthly look at it. It's just critical at this point. They have to do this. If they don't, then I think maybe credit rating will go down, or we'll see. But when they do this, if they're not pumping it up, they're not pumping the economy out, they're taking liquidity out, then money managers will be a little concerned, right? Fed quantitative tightening in 2018 by 10% resulted in, so this happened in 2018, right? So what happened to the stock market in 2018? Can we use this observation to confirm that this is a central bank game, potentially? Let's look at the performance right here. So I know this is a eye candy chart, maybe. 2018 is this one right here. So what this is it does the performance of it shows the yearly performance of the S&P 500, where the yellow is 2011, 2012, 2013, and 2009 is right here. It's not quite done, right, because we're in February. But 2018 is the first year that was negative in a while. Because the other year was this red one and this yellow one. So red one would be 2015, which is, makes sense as well. So central banks started tightening their financial balance sheet, right? You saw that in the chart right here, starting when? 2018, right? So what happened to the stock market performance? Every other year it was up, especially this year, 2013, it was up 30%. That was the year to buy a house. That was the year to get into like becoming a developer. Man, leverage all the money you can and just play the game. But today they're taking money out of the system, and it's at at negative 6%-ish for the year in 2018. So just something to be mindful of. Did that make sense to you guys? Or you guys, any questions on that?
If the interest rate is so low, so you're buying bond, is it going to be losing money?
If the interest rates are so low, if they rate,
2.5, right? You can't go anywhere. It's not.
no, I don't think so. Yeah,
This is like zero. I mean, you're
I
losing
don't think they could raise it to 5. They raise it to 5, the stock market is going to tank.
I know.
So it's like it's a guaranteed win almost,
Huh? Guaranteed win.
right? Because if they can't, it's at 2.5%, right?
Yeah, they keep dropping. But I mean, you want to buy any more bond.
Yeah,
Then you
so
don't pay
educational,
much.
educational purposes only. Let's say you get in at 2.5%, they can't raise it to 5%.
I know.
So they can only go from 2.5 to 0. If it goes to 0, then what happens to your bond prices? It goes
Go
up.
up.
So I shifted to bonds.
Mhm.
Yeah, I'm in bonds right now.
You in bonds right now?
2019, they want to expect 2 hikes only, so it can maximum go 3.
Yeah,
And
right.
what was the QE? Is it on autopilot now, or they're setting it
Uh,
on halt?
They're still doing the QT. They're just giving verbal confirmation. Not even confirmation, verbal.
They're gonna be data dependent.
Yeah, they're going to be, so.
They have halted the autopilot mode of QT.
They're saying that the data, before it was autopilot no matter what, now they're saying it's data dependent. Things get bad, they're gonna make adjustments to this.
Yeah, so for the most part, guys, there has been no QE. This is the Fed balance sheet at another angle, because you get to see like, okay, they got mortgage-backed securities right here, right? Especially in 2008. 2008, they started absorbing the mortgage-backed securities, right? To absorb the economy's loss.
So
Crazy, huh?
They're not even able to pull the money out without
It's
stock market coughing.
It's solidifying. That's what we talked about last week, or maybe 2 weeks ago. It's solidifying. And if it's solidifying, because, okay, if interest rates, like I said, this system's decaying, if it goes from 1 to, it's going to get to a point where it's at 1.25, they're going to go to 0. And what's the other tool they have? QE, QT. So, but if that's the case, then they're going to solidify the QE. If they're going to solidify the QE, then shoot, like, we're going to look really bad. But this is across the board around the world. So that's the insane, I can't tell you where it goes next, because there's no financial textbook that'll tell you where this will go next. The only people that could tell you where it goes next are the practitioners, the money managers.
Japan did this. So Japan has
Yeah. So I have Japan's balance sheet right here as well.
Japan just
So
recently announced they do QE. They still do QE.
yeah. So you guys are skipping ahead already.
Quantitative easing.
Oh.
Yeah.
Can I make a point on
Yeah.
So just basically the difference between quantitative easing and federal rate cuts is like, it's so a big difference between the two. It's like, for example, rate cuts is like having a bicycle,
Yeah.
and then quantitative easing is having an airplane. So it's just such a huge difference between the two, because the Fed can lower rates a quarter, and the market will still go down. But if they ever decide to do this again and bring it from 4 trillion to 5 to 6 trillion,
Yeah.
we're gonna go to new highs, guaranteed. Right?
Yeah.
Because that's an airplane, like it's such a massive weapon.
Yeah.
It's dangerous, but it's
So-
massive. So I'm saying that rate cuts is a bicycle.
It looks like
this is an airplane.
Looks like we all got addicted, right?
Yeah, this is
Central bank around the world.
Yeah. We're
I think
addicted
so.
to the easy money for sure.
If we analyze it.
So we're very addicted to the easy money. I wish I was, more. I wish I was like this in 2013. All right, but I'm more educated now, so we'll see how it goes. I still could squeeze out a few more super cycles. Because I said the next, we get to the next bottoming cycle that I perceive is a bottoming, then that's when I would leverage up and become like a developer or whatever, right? Like just really, power to the.
Okay, one more thing on quantitative easing. What they're doing right now is all the interest, when they expire the bonds, all the interest that they were going to get, they used to just let it run off, what they call, right? And then they basically said, we don't want you to let it run off, we want you to buy some more
Yeah.
with that interest. It's not
Yeah.
even cutting the bond.
Yeah.
And we're talking about the interest is being
Yeah.
run off
Yeah.
right now.
So it's scary. So we talked a lot about the USA Central Bank. Let's look at the other DMs. European Central Bank, Japanese Central Bank, right? So this is Bank of Japan, guys.
If you say interest rate 2.5 the most, but inflation is 2%, are you losing money? If you even invest
Yeah.
in a bond at 2.5,
Yeah,
right?
yeah.
Big deal. Your inflation is 2%.
Yeah,
If
yeah.
you're dropping it to 2%,
Yeah.
you're just breaking even. You don't ever make money. You're just treading water.
There's
You
no,
drop
there's,
lower than that.
because there's, I mean, okay, if there's nowhere to hide, if you're in cash, you lose money.
The bond
So
is
you,
still like
I know,
you're
it's,
treading water. You're not even.
so that's where today we're gonna talk, well, I got 30 minutes left. We're gonna talk about this huge gap, inequality risk that I see. Meaning that it's not just a financial economic game, there's like this, the central banks they are in charge of, they have the responsibility of, if they continue to push up prices, what happens? That gap, that wealth inequality expands. And we know by history, right?
Yeah.
If it expands too far, there's social uprising and all that.
We've seen friends.
Yeah, yeah. So in my opinion now, at this point, they have to tank the markets to deflate things and let the players get back in to have a sense of wealth building. Because they control the money supply. They don't care about wealth building. They care about you following the system, right? That's just how the game works. Every empire is like that. Every empire will rise and fall. And every empire will devalue its currency to get what it wants, right? To get people to fight for you, you devalue currency. Maybe I shouldn't talk too much about that. But that's the name of the game, it looks like, across the board, around the world. Bank of Japan, European Central Bank, Federal Reserve. So this is what the balance sheet of Japan looks like. So they started buying assets around 2013, it looks like. 2013 looks like the year where everyone went aggressive printing, or aggressive buying. Very fascinating stuff. So I think Japan's rates are even lower, right? Aren't they like 0.5?
Negative.
They're negative, right? Yeah, insane. So, but yet the economy is pretty, right? So what does this tell you? It just tells you that only time will heal it. Like we can't artificially pump up the game anymore, right? And I know that, and I know that I'm going to be facing pretty tough economic environments moving forward as a millennial. Ugh. But,
Around the world, not just US. All
yeah, around the world, there's social, so that's where I feel, okay, we're talking about social instability, and there's this thing called Bitcoin. It just seems like, I know, now you're like, it's just another angle. It's just, it's like we're not even running to Bitcoin because of the technology or the efficiency, we're running to it because the system's dying. It's,
But you also diversify in many ways.
yeah, I diversify
Right,
in many
so
ways.
that's-
For the most part,
that's-
gold is my go-to, gold miners.
But you also do equities, so you do
Yeah,
Bitcoin
yeah,
a
yeah.
percent. That's fine.
So my whole theory is I'm into the whole performance lifestyle. Like I guess I kind of grew up in the environment. See, man, you just got no choice in this economy, man. You want to make it, you gotta like put in extra hours, right? Yeah. Well, let's move forward. So Bank of Japan. So 30 more minutes, okay, guys? But you guys are welcome to leave any time. Don't, it's not disrespectful or anything. Bank of Japan, balance sheet. This is what it looks like, all-time highs. Let's see what they do. We'll continue to monitor that. European central banks. They put in an effort back in like 2013. But, after that, breakout higher. So,
They almost went back to recession.
Yeah.
Started doing QE.
so this is another key thing to look at when we want to predict prices, right? If DMs around the world are accumulating assets, central banks of DMs around the world are accumulating assets, then that's a major signal to go along, right? We got to play with the central banks now. So the expansion of wealth inequality is what we're going to talk about next. And this is pretty interesting. What happens if the Feds don't perform quantitative tightening? If they don't pull money out of the system, then this game will continue to inflate. And if it continues to inflate, what I'm seeing these days, the people who can afford like a $1.5 million home is basically 2 engineers from Apple or from Google or Facebook. That's really, and everyone else is just like, I'm renting, bro. So Yeah, the question is, what happens if the Feds don't perform quantitative tightening? This is an underlying issue and a new risk that I'm starting to see related to the relative wealth level of the population. Do you guys think, okay, let me ask you guys this. Do you guys think that they might artificially engineer a downside now just to allow a chance for, you know, the demographics that don't have any chance? You don't think so? So you think that they're going to hold prices sideways? They're going to manage it sideways versus manage it down. Yeah. So then would you go long, or would you play volatility? Or how are you going to play this? If you just told me that it's going to go sideways, it's going to be a managed sideways. How are you going to capitalize as individuals? Right? That's something I think about every day.
No, I think the market will go down, but it's not going to be because the Fed is trying to bring it down. The Fed is going to try to prop it up, but it's still going to go down.
Yeah.
In spite of it.
Yeah, I think so. I think it's because whatever they do with interest rates, it's like a 6-month, 8-month lagged, right? Whatever you do is going to happen 8 months later. So they won't be able to save it. If it catches momentum, that knife drops, they can't catch that, man.
Unless they do another QE for another trillion.
Aggressive QE.
Yes.
But if they do aggressive QE, then hey, gold will
That's
shine,
what
man.
yes.
Put on your shades because it's going to shine.
Has that connection inequality really changed in the last year to 2 years?
Yeah, I mean, I think you could tell because, like I said, the 2013 to 2018 real estate prices I saw, I have data where you can see who bought it in 2013, right? And then you see like a 700K gain. That's incredible. That's almost like 100%.
That's 6 years though. I mean in the last 12 months.
Yeah,
So that
but that's
whole
something that should
wave-
be, in my opinion, that type of, they didn't manage the economy well, right? If you're going to manage the system right, you want it to be slow increases, because if people get rich too fast, how are you going to create the next innovation? How's GDP going to really grow? Right? Like, well, okay, let's say we have a recession, and I can't, as a millennial, I can't buy anything. I might be like a more like robust entrepreneur because I'm in like a tougher environment, right? Huh, I didn't think about that. But yeah, going back to your question, I don't know, man. I don't know. The further the wealth gap grows, the more social instability. If history repeats itself, social instability can tear a country apart, right? Something to think about. So here's some interesting charts. Statista, a trusted source that I like to use, where financial inequality is rampant. Share of wealth held by the richest 10%. So USA, quite a bit, right? And then the rest of the world, Europe, and then Japan. Just some interesting charts. How is the world wealth shared among its population? 71% of the population owns about 3% of the wealth, while 0.7 owns about 45%, right? Another visual look at that is probably this picture right here. Yeah, pretty interesting. The poorest of the 50% of the world. Man, I love economics.
That's incredible.
Michael Bloomberg? Yeah. That guy's probably the analytics god. Yeah, he got all the data he needs.
That's incredible. So 8 people have half of the wealth of the world.
Yeah.
This is the reason why we are seeing a lot of the socialistic calls everywhere.
Yeah. So this will, I mean, like I said, if they inflate the gain, the reason being is that 90% of the population, they're not like me. They don't look at investments. They don't know anything about investments. They have poor money management. They don't know finance. That's kind of, and so I'm in like an evergreen niche if you think about it. If I started like a finance business, but it's tough. That's just the nature of the game, because as soon as they inflate the economy, well, the capitalists who have a position, investment position, they benefit. So this is why you should get into investments, literally. If you don't, every day your dollar is declining. Here, I'll give you an example. Your salary, you make 100K. Inflation is 2%. Every year you're down 2%, right? Because you're an employee. You're not a business owner. If you're an employee, every year you lose 2%. If you're an employer, that means every year you gain 2% because your employee lost 2%, right? So if you sell a cup of coffee, I said this before, $4 a cup of coffee. You're a business owner. You sell $4, right? It went to $5. You just made more money, bro. It just went from 4 to 6, and now you're selling $6 units. So it just pays to be on the business side, the entrepreneur side. Crazy, right? Let's talk about that a little bit. So the logic of wealth inequality and the importance of investing, and why I love this club. I am the founder, I guess, but anyways. Example, employee versus employer, right? On the employee side, you have consumer tax bracket. On the employer side, you have corporate tax bracket, which is lower, right? And employee side is like 40. Employer side or corporate side or business owner side is like 25%. If you're strategic, say again? 21? Yeah. See, so by plus the loopholes, right? So by default, if you shift out and become a business owner, you just win by like half already, right? Now you're on the employee side. Your wage growth headwind pressures from employers, because naturally, if your employer was honest, if any employer is honest, and I mean I don't see it today. Tell me which employer pays extra 2% every year, because inflation, the inflation rate goes up 2% every year, right? This is the inflation chart all the way back to 1880, right? If it's 2% as of most recent, then let's say you get a bonus, 5% bonus, it's really a 3% bonus, right? Because every year your money's going down 2%. So you need exposure to inflation-proof assets. That's why most people drop the dollar and go to real estate, because that's inflation-proof. That thing goes up with the inflation, 2% a year. But if it's going up 20% a year, there's a lot of hype right there, right? So that's just something to kind of analyze. So how do you feel about knowing that? Anyone?
Well, this is why we have the proposition for OAC at 70% tax rate, anybody making over 10 million.
Yeah.
We have the Warren proposal getting a 2% wealth tax, anybody having assets over 50 million per year.
Yeah, like tax these guys, right?
This is why it's catching on.
Yeah, because JC and I were just talking about earlier, right? There's social gap, or wealth inequality gap that's expanding, and that becomes risk because empires could fall, and they don't want the empire to fall, right? So how do you nerf that risk if the gap is expanding? Well, you could tank the economy. It's just one speculative philosophy I had. Or the back end would be, instead of tanking the front end, the economy, you charge it from the guys who already won to give it back, to sustain that gap, right? To lower that gap. Man, I never thought about that until like just recently. So yeah, it helps to teach because you learn a lot. Anyways, so if inflation is at 2% year over year, then employees lose 2% a year on salary unless matched to market rate or annual raises equate to inflation plus more. So you ever think about this? Like people jump jobs after 3 years and then you get repriced to the market rate. Because let's say 5 years ago you get a job here, right? They're like, okay, we'll pay you 100K, right? And then over 5 years, because of inflation, the market price of your skill set went to 150, but you're still getting 100K. So you lost on that, right? But then you're getting like hit up from recruiters on LinkedIn or whatever, like, we'll pay you market rate, man, 150. Why are you getting 100K? So it kind of explains how employees kind of jump and turnover. Interesting, huh? So if I ever become like a CEO or a business owner, those are things to think about. Like, if I was really fair to my employees, I should give them that 2%. That's a respectable CEO. But if you do that, you gotta squeeze out performance, because if your company doesn't perform, right? So that's why you work for an organization. It helps to get equity exposure, stock market exposure. It's inflation proof, because as the business gain with inflation, it just makes sense. So what else do I have here? This explains why employees jump jobs to get repriced to market rate. It's just something I never really think about, but super duper interesting. Corporate tax bracket. Okay, we talked about that. Inflation tailwind support. Okay, so yeah, I already talked about it. Every unit of service inflates in value, so employers are protected due to appreciating units sold. So as an employee, there's wage inflation, right? But we don't, as employees, you don't really realize that, because unless you have an extremely honest employer. Anyone giving 2% a year? GE gives 3%. Just saying.
Government does that.
To add on to this, right?
Yeah.
The government also gets inflation protected tax returns every
year. Yeah. Man, that's crazy, huh? They engineer that.
Yeah.
Wow. Okay, well anyways, so the inflation rate, just the rate is about 2%, you guys already saw that. And then the consumer price index right here. All right, so just prices just tend to rise, right? If prices tend to rise, then stocks should rise, because every unit of sale goes up. The iPhone's no longer, what was it before, $300? It's like freaking $1,200 now, right? Things have to stay fixed. If not, then there's no, government bonds cannot go bust. If it goes bust, there's gonna be like, I wouldn't say total war, but like, what's the whole point of this game then, man? Like that's literally the question. If they go bust, what's the whole point of this game? Like, why are we even working for money? right? I'm just gonna buy gold. That's literally how money managers think about it, I feel. So, 15 minutes left. The key takeaway, guys: make sure your efforts are inflation proof. Make sure you get on the inflation side. If you jump to starting a real estate business, like one, yes, you start your own business, you're on the inflation proof side. Two is real estate prices go up, so commission goes up. Just something to think about. I'm not saying go become a real estate agent, but go become a business owner or something on the inflation proof side. Become a stock investor. That's inflationary proof. Other ways of applying the same thinking. Population is inflationary. Therefore, invest in a network. Build a network. That's one way, right? So the big question that my takeaway after this is, are recessions and expansion cycles artificially engineered?
Become more and more.
It's interesting, man. I just kind of came to that conclusion this week. Like, you know, I thought this game was pretty legit, but now it's like, you know, the way the game escalated. It's a game. It's a game, you know?
Yeah, game.
You ever hear like the whole Monopoly board concept? We take out the Monopoly board, we'll play the Monopoly board, and then we put it back in the box. Game's over. And then we'll play the game again. That's the same thing as economy's rising and falling. Right? We play the Monopoly game until someone wins, and then, you know, we put it away, and then we start a new game. That just seems to be the pattern of life. I'm going to live for so many years, and then I'm going to die one day, and the next the next generation will reap the land or whatever, right? So pretty philosophical. But after some point, there's no finance books that will teach you anymore. You'll hit the top of it, and the end game is really just to play the game, like, you know, invest or whatever. So that concludes the talk for today. We talked about central banks, we talked about bonds, interest rates, and we talked about wealth inequality. Just something to be aware of. Right? And then that's it. We'll talk about some stocks after this, but that's all I got today.
It's a good one.
Yeah.
Especially on the engineering part of the recession, expense recession. I never understood why there was a QE3, QE1, QE2, understand. But there was no reason for US to do a QE3, right? Everything was good. It was straight after 2013 they did QE3. 2013 was a very good favorable year. So that's where I lost the understanding of the system. QE3.
Yeah, QE3 is interesting.
So it was a big one, and market was good. Employment was
So-
getting back in traction. There was no reason for central bank to do it unless they looked at Europe, maybe.
Yeah. So I have no idea myself.
This is definitely engineering for no reason. They were only supposed to look at employment and inflation. Both were mute.
You know, I mean, some questions are left to not be answered. Because if you escalate that far, you try to answer those questions, you're gonna have a big brother watching you or something. So stick to the boundaries of the game, I'd say. So I'm sticking to, you know, just being a money manager or investor or whatever. I wouldn't want to escalate too high. If I go too high, then
No, that's a good thing because now I know they're going to do this. I need to work around it, not.
yeah, exactly, right? If more people knew this, they would work around it, right? 8 out of 10 recessions were caused by the Fed decisions, so yes, they are engineered. In the last 100 years of U.S. financial history. Okay, cool. That was a comment that was online. Okay, guys, that's all I have today. We could reserve the last 10 minutes to talk about stocks or just hang out or whatever. Any feedback you have about today's discussion. I know we have some, you know, first timers in the back and front. What do you guys think? Was it okay? Not too much, not too heavy. You had a comment?
Well, just a comment. I'm 55 years old, okay?
Yeah.
And I had no financial knowledge. What are most people in 30 in this room? Like a lot of people are, right?
I'm 28.
30s, 20s, 30s. I think it's fantastic that people are building up that kind of financial knowledge at that age. I think a lot of people don't really pay attention to it until it's too late. And I go to some of these retirement kind of things, and you see people that are 50.
We'll make a video together now.
Well, no, you see people that are 50 that have not really studied it or concentrated on it at all, who have massive debt, who really don't know what they're doing.
Yeah.
And here we have a room of people that are in their 30s who are building up that knowledge. It doesn't guarantee, you know, certainty of performance, but it's certainly building up the knowledge to be informed on how to evaluate, which is terrific. I think it's great what you're doing.
Yeah. I had something I was going to say. It was pretty interesting. it just kind of like left my mind. I don't know if you know, but I'm like a capitalizer. But I look for unique economic opportunities. That's not just money, right? I'm looking for a personal gain. That's not just money. Yeah, you pocket on that, but you could gain from building a LinkedIn following. That's a way of capitalizing on a network, right? I'm just kind of responding to my externalities.
Yeah.
I as a millennial, like, what can I do to survive in this world today? I'm just adapting to the situation, right, as I see fit. But there was something I was going to tell you just now that was really interesting. I forgot. Darn. Sorry, I'm like trying really hard to remember what I was going to say. Huh?
This is more of an exception than a rule.
Oh, so most of the people my age, like 28s and stuff, they're still figuring out life. And I've been blessed to have the internet, right? And so I enjoy reading, just like a personality thing. But knowledge compounds over time. Like, you learn it once, it kind of just grows in your head, like 2, 4, 6, 8, whatever. But damn it, I was going to tell you something just now. I forgot. So, anyways, guys. So I'm really trying hard to remember what I was going to say. Okay, well, anyways, that's all I have today. We could take a look at some stocks for like the next 10 minutes. You guys have some cookies in the back. Thanks to Bill for bringing it in. Yeah, hey, you guys are welcome. So let's see, what do I have down here? Some stocks. So EA, we already talked about that earlier.
Can we look at Coca-Cola?
Yeah. So one I wanted to talk about was CTL, CenturyLink, because this one's paying about 15% dividend.
15%?
Yeah, 15.
They got earnings this week.
Yeah, they got earnings this week, so I'd be careful with this one. But to me, it's let me pull up my stock.
They pay a 15% annualized dividend?
Because they went through a huge bear market, they went from like $80 a ton.
Yeah.
You know what I mean?
And so when I look at this stock, I'm thinking like, okay, yeah, it's still in a downtrend. It could go lower, but it's on watch. This one's on watch. But they have consistent sales, right, across the board, 18 billion every year. It's not 100 million sales, it's 18 billion in sales, right? But they're losing money. Earnings are going down, right? So you got sales, but your earnings are going down. But I like it because it looks like they could sustain this 15% dividend. Now, 15% is pretty lucrative. You put in, I don't know, 15,000, 10,000, you get 1,500 a year.
What's the dividend history?
Dividend history is pretty robust. Let me show you in Guru Focus. So CTL, not a recommendation, all right, guys? It's just something that popped up on my scanner. Dividend wise, man, 15% is nice.
Is it sustainable though?
Yeah,
A lot of times
they cut it, it's going to be tanky.
Yeah, so that's the risk that I noted right there. So I would wait until after earnings, but right now.
They announced the earnings?
This week, I think Wednesday or Thursday.
This week? Oh.
Yeah, but this is the historical right here. Dividend yield all the way back to 2010. So we got about 8 years. So it's been pretty consistent with the prices, right? And then the highest was 15%. So again, it's at the high. So dividend might predict the bottoming of this stock, depending if they cut it or not. So I would wait until after earnings to get some more insight. Listen to an earnings call, or read the press release or whatever. But 15% is where you gonna get that in this market, man? Like, yeah. So don't get too hungry, but like just be careful what you do always. Like don't depend on me as like he's gonna give me great like investment opportunity. Yeah, exactly. That's the whole point of it. I'm just saying like, dude, this is what I'm seeing. Yeah. So the beauty of this trade, real quick, is there's potential upside, right? You buy it at 14, let's say it really appreciates or recovers back to 30. That's not bad. There's appreciation and 15% dividend. But we'll see how this plays out. I'd be cautious. Do you have a comment, Bill?
Is it rumor to CTL to acquire Zoya?
CTL to acquire Zoa?
Yeah.
I haven't heard of that company.
Yeah, so Google and CTL is looking for acquire Zoya.
Interesting.
It's
Okay.
rumored.
Yeah, so I'm not following the corporate acquisition on this one, but yeah.
Maybe they use the dividend to buy the company.
Yeah, but it's a strong company. It's trading at 0.66 of book value. It's undervalued.
Is it an internet infrastructure company?
No, it's a wire. It's not wireless. I think they're acquiring wireless. It's a wire infrastructure.
Yeah.
So things like internet and stuff. So they acquired level 3 communications.
5G is not like a 5G.
I think there's a 5G play as well.
Okay.
But I would dig deeper into this. It's just something that came up.
Cable company famous around Seattle area.
So, yeah. So, I mean, if it's at 0.66 book value,
I'd be very cautious with this. Any
You think
stock
so?
that has earnings that are going down, sales going down.
sales is going sideways, earnings is going down.
Well, but you're in an industry where a lot of communication companies are
Yeah.
gaining in EPS and gaining in sales. So it's look at that graph, right? I mean, it's like you're kind of betting on a company who has got negative momentum in terms of their overall value.
Yeah.
So it's you can bet on anything.
That's true.
But you are betting on a company that's going this way, not on an Amazon or other that are going this way, right?
That's why I would say wait until we see. Right now, there's down momentum. We're looking for sideways momentum in
Right,
anticipation of upwards momentum. Right?
Sure.
But for now, it's like, well, 15% is being marketed in front of money managers' faces.
Yeah.
You're like, oh dang, 15% popped up on my scan. This is one of the $1 billion dividends that 15% double-digit dividends out there. There aren't that many. I did a scan. You could perform a scan easily, right? If I were to do here, I'll show you the scan real quick. So if I were to do a scan, look for a high dividend earner. So I want something that's a serious company. I do mid and up, so mid plus right here, so over 2 billion. And then dividend yield, I want high because I want more than 5%, right? And then 5%, let's go to financial. And then let's say I want something undervalued as well. So I go to my fundamental and put in the price to book value below 1, right? So it's below net equity value. And then I look at all. So what do I have? This is my list right here, 2 pages. But I want the highest dividend. So I'll go to, everything's like 5% right here. So the highest one, I don't know about this one, BDL, but the second one is CTL, right? And then you got like KKR, Capital Group, so private equity right here. Publicly traded private equity, some REITs right here, paying like 12%. But these are some great dividends right here. Find one that you really trust. So one that I really trust would probably be AT&T, which is a little bit lower. So AT&T is down 6% right here. Except AT&T is not undervalued. These are undervalued, right? Meaning, market cap is 100 billion, but they got 150 billion in their balance sheet. So
this would, you're getting all this because you're paying for it. It won't be available on the free stuff.
no, you got it. It will be available with ads. That's like the name of the game in the digital world.
So you want to have some fun,
Yeah.
just for fun rather than investing.
Yeah.
3 days before the X date
Yeah.
of a dividend being declared, let's say the dividend's on Thursday, you can buy the stock on Monday. People tend to load up to get the dividend that's going to hit on Thursday. You have now the dividend, the stock goes down, the value of that dividend that same day.
Yeah.
And then if it keeps going up, then basically you essentially made like a 2% return on a 3-day period.
Wow.
So,
Yeah.
you know what I mean? Like, if you play right, or if the stock crashes and so on, you hold it and you made a 2% return over 2 weeks.
Yeah.
But people do that all the
That
time.
sounds like a tactical dividend trader.
It does have a pattern
Yeah.
that happens all the time.
You know what I mean?
Same thing with earnings, right?
Yeah.
You were saying that any company that has earnings, people the day before and 2 days before speculate if they think the earnings will be, or the guidance will be positive, right?
Yeah.
So every single company that announces their earnings,
Yeah.
that day or the next day will either be up or down between 5 and 10%,
Yeah.
right? Almost every one of them. So if you have that crystal ball, or if you're into having fun rather than investing, it's now about gambling. If let's say, what's it called? Cisco. Cisco's going to announce their results on Tuesday or Wednesday.
Yeah.
So that stock is going to move 5% up or down based on their guidance, not on what they did, but what they say they're going to do.
Right.
So if you want to just have some fun and say, I'm going to put some money in and I might make 5% or I might lose 5%. I'm not going to make 50%
Yeah.
or lose 50, but I'm going to just roll the dice and be in a bar one day and see what their guidance is. And if they say their guidance is better than the industry average, you made 5%.
Yeah.
If it's negative, you lost it. And you just sort of roll the dice and see what happens.
Yeah, people already did the
Let-
experiment.
That's the casino.
So let's watch
Yeah.
CenturyLink this week, right? Let's see
Yeah.
how money managers respond. If you see significant volume and price rise, then
Yeah.
someone's watching this. Someone big's watching this.
Sure.
Yeah. But yeah, that's all I have for you guys today. 12 o'clock, 2 hours, number 105. The next
Let's
week's going to be
go again.
106. I hope I didn't blow your minds too much today, or I don't know if I even did blow your mind. some comments online. Do you have a comment, Ed?
Can you pull out, you say you want us to bet on gold, what's the last gold run in the past 20 or 10 years?
What was the last one? I'm sorry.
The gold,
Yeah.
the gold run. I mean,
Like what was the price of it, or?
yeah.
Yeah.
Right, history.
Yeah. So this is the.
What caused that? I mean, what,
Oh, what caused it?
well,
Yeah. So here's gold. Let's explain. Let's overlay this with the central bank balance sheet real quick. So it's already 12, guys. I don't want to force anyone to stay. You guys are welcome to leave. Okay, don't let me hold you back. So let's overlay that right here with the central banks and see the performance relative to. I should actually do around the world. ATV, yes. SKO. I got a lot of people in the room. I'll try to get to it in a bit. Let me see. So Siri acting up. So let's overlay it right there. So this might not be perfect because I want to do it from 2004. So what can I do to, because 2004 starts over. All right, let's just draw. I'm just going to draw on top of it, all right? So hopefully you guys could see it. Is it a little blurred? So I'm going to look at,
that's good.
that's better. Okay. My eyes are like,
Gold went from 255 in 2001 to
Yeah, it's like a peak in
1923 in 2011.
okay, so let's look at this. So the moment they did QE and
One
QE,
until 12, and then go down.
so let's put,
Oh, the chart looks good.
so this looks about, I think that's 2009. 2009 right here,
Yeah.
right? And then this one is 2013.
What causes that? Or down for that?
I personally probably would say it got overbought.
Well, gold went down with the 2008, just like stocks did.
The other thing I want to
As
put is the
soon as
dollar.
they did the 200 reads, and then gold started skyrocketing.
I forgot to put in the dollar as well, not just the central bank. So because I want to see the dollar value as well. Let's see if we can do that real quick. So dollar index on the monthly. Okay, it's going to be a bit of an eye trick right here. So looking at gold and also the dollar, right? So 2013 gold started declining. 2013 dollar started rallying pretty hard.
Close follow
Yeah,
the dollar,
so
right? It's kind of, I mean,
they both follow each other, and when they don't is when you want to pay attention to that signal. When they don't, that means something's going on in the economy.
yeah.
Yeah, the word of mouth is in the between stuff.
Yeah, a couple of, if I can add a couple of comments, right? I think dollar going down helps gold,
Yeah,
and especially if the market thinks that the Fed is losing control of the economy,
yeah,
that's when it really starts going up.
yeah, yeah.
So
Okay.
you're saying there's an inverse relation with that QT to the gold value? Is that
No,
what it is?
I was just kind of analyzing, see if there's a difference or
There
anything.
is
Yeah.
with QT.
Oh, okay.
Thank you.
Hey,
You're
thank-
so very helpful.
Yeah, thank you guys. Well, I guess let's call it a day. Let's chit chat or hang out. If you guys have any questions, I'm pretty beat up.
Next session, you can just message you, right?
Yeah, yeah, feel free.
Okay, thank you.
Yep.
Have a good weekend.
You too. Any investment opportunities from you guys? Anything interesting you guys are seeing?
Well, I'd be interested what your thoughts are on Cisco there. Are they
Cisco?
going to rebound after following a lot of the other tech companies?
Yeah, Cisco's a more of a mature play, so I wouldn't expect a lot of growth. What's the
CSCO.
CSCO, right? That's what I did. Oh, CSOD. Okay. So this one's more of a mature play. I want a bigger picture view. It looks like, okay, setting up to go higher, not bad. Gross margins are good. EPS is good. Sales is good. Shares outstanding is also good. How many employees? 74,000. I learned that if you have about 500 employees, you do about 100 million. 100 million in sales.
Say it again, what is that?
If your company's about, so I look at the startup realm, if you have about 500 employees, you do about 100 million in sales. Pretty interesting stuff. Let's see. So for the most part, growth story, I don't see excessive growth, but what's the market pricing in as of 2018, it looks like. 2018, nothing. Maybe some acquisition, it looks like. I mean, for the most part, it looks okay. What's the dividend? 2.8%, gross margins 2. How about the leverage? How much debt? Okay amount of debt, not bad. Current ratios there. Price to book, price to sales, price to earnings, a little, at the market rate. What do I think about in the near term, midterm, long term? Which one?
Well, this is one that, do you think their guidance will be positive which would move the stock back up to the 50, towards 50. But not a huge movement. I don't think it's going to move hardly at all.
Yeah, I don't think there's going to be a huge movement. From the way the market reacted, it looks to be following the index as well. So for the most part, if I were to watch this, I'm going to just follow the index. And I think it might go down, but earnings is on next week. So if you want to play earnings, I mean, I think earnings will make it move, but not too much. It won't move beyond 50, I'll tell you that.
The chart doesn't look good, right?
It looks, yeah, it doesn't look that great. There's nothing attractive that I see. Like EA looks more attractive to me. It's very clean. I could see that the downtrend kind of subsided a little bit, and I could see the aggressive interest as the most recent, right?
What caused that 16% up?
The 16, so it actually gapped down on earnings right here,
Oh.
and then people just dip bought like the next few days. I didn't think it would go up $13. I was I was looking for like a $4 trade, but yeah, not bad.
How do you think the whole game sector, like ATVI and also Take-Two,
I'm
all beaten down these days, right? All the game sector.
Well, we could look at that. I don't have a game ETF proxy. Gaming ETF.
I mean, compared to the past, they do all pretty good in the past couple of years.
BJK. Yeah, let me look at this. BJK Holdings. So you could get a proxy on that. Let's see what they have in the BJK. So apparently BJK will give you insight into the gaming world, right? So yeah, it looks like this. It looks like emerging economies almost. So it looks like it's going with the some cycles right here. But I want to see what they're holding in their ETF, just so that I could get an understanding. So the biggest, excuse me, I just burped. Let's see. Come on. Holdings. Okay, so for the most part, percentage of assets. So Galaxy, so Hong Kong ticker, huh? So it's a global, all right. Well, daily holdings. Where's ATVI? No, I don't think that's a good gaming ETF to leverage.
With the hotel too, I want a pure.
Yeah. Video game ETF. So I don't know of an ETF, but only video game ETF. Let's see. Something with an Activision. So that's why you have to check the holdings. It's like it's not a good proxy in my opinion. ETF holdings, ATVI, nope. The only gaming ETF. Let's see what this guy says. Yeah, I don't have a good proxy like I do for semiconductors or transportations, but
it's too small, maybe, or
might be too small, or might not have enough interest to sell that ETF product, right? Because as an ETF creator, you want to create something that's super popular, like the S&P 500. Then people will track it and trade it. But I guess not enough interest. But I think you could do some digging because there are some exotic products out there that there's like long-short ETPs, which is pretty cool. But yeah, you guys want to leave the gold stuff, the gold positions? Not too bad. Let's see, gold portfolio, gold miners. So these are the ones that I'm looking at. Let's look at their performance over the past, let's see, since November, right? So that's about a quarter ago. So this is the, KL did about 66% 3 months ago.
That's amazing.
NGD, 38. So only the losers, the worst one is this one, about 8%. But everything else is like double digit stuff. So I still personally think there's more upside, educational purposes only. But yeah, I think when I met you for the first time, that was when I was like kind of, was that November? December?
December.
Yeah, so November was when I started looking at these positions seriously. So GG November, right? This is one that I took a large position in. The options actually paid out for me. I thought the acquisition news was like, oh, bummer, but it actually paid out. Like I held it out and it paid out. So I sold some and now I'm repositioning into AGI. AGI is the other one that I'm probably going to play heavy, but we'll see.
You think that one's going to move, AGI?
Yeah, it's below book value, 0.64, right? So when I do bottom picking, I like to pay attention to book value. But for the most part, yeah. And then the most recent position that I have is past in terms of the metals economy. The metals economy, for silver is past. They're number one, hands down. And the guy who, the CEO, is very passionate about the gold mining stuff. I think you probably know that already. So SK has ESPO, which is a gaming ETF. Great way to get my attention through the chat. So I might want to check the holdings of this, but at ESPO maybe we could look at it later. So let's see if I can reply to some people online.
What is your multi-bagger?
What is what?
Multi-bagger stocks that you have, holdings, stock holdings, multi-bagger.
Oh, multi-bag. You want to see my multi-baggers?
Yeah. No, how they're doing last quarter? So now we have a lot of them.
Yeah, I have a SaaS multi-bagger portfolio. You ready for this? You guys ready for this? Tell me what you think. This is my multi-bagger where I think it could go 5, 10x. Educational purposes only, okay?
Those are solid companies.
Yeah.
Longer term, yes, but.
So you like FireEye now?
Huh?
FireEye.
FireEye, I believe, could be acquired by Cisco easily, and I would play that acquisition. Yeah. So there's beauty in being in the valley.
Exactly.
Beauty in employees coming from these companies in here and just talking about the next digital opportunity. That's why sometimes I look away from real estate because that market's not as exciting as technology.
You feel like something more dynamic with stock?
Yeah.
Because real estate in general is buy and hold, right?
Yeah. So for the most part this year, I was speaking at the beginning, is this year I'm going to build up a digital economy and see how I do it. It worked out on my LinkedIn, 16,000 connections. So now I'm going to push something else. I live for the push, I guess. Yeah.
That's great. That's
Yeah.
really cool.
Well, anyways, guys, I'm pretty beat. Let's call it a day. I'm just going to be cleaning up, but you guys can hang out and chit-chat with each other, or if you have anything you want to talk about, feel free.
No, it's a really good meeting.
Yeah, thank you, man. Thank you.
The economy stuff.
Yeah. I thought last week was really interesting.
Well, the last one on China, you were talking about that app that consolidates everything, right?
Yeah, WeChat. Yep.
So if you could use the brain power to predict what will be a similar type of consolidation here, then you would be looking at the winners, right? Like which companies are likely to suck up all these little fragments into a bigger one.
I think
and then over time win.
I think it'd be Google and Facebook, but there's so many strong players individually that it's really hard to acquire or consolidate. Like PayPal's too big to consolidate with anyone.
Yeah.
It's its own titan now. So.
But then you see the rumors of Apple looking at Netflix as a possibility, right, for content.
Yeah. Well, Netflix, maybe.
Well, it's just been speculation, but it's a fascinating subject.
Yeah.
Expensive.
Yeah, absolutely.
$155 billion market cap.
Yeah. But maybe that's the cost to get into content, though, right? If Amazon and others are building up content value, Apple has basically none. Yeah. Then that's the price to get it.
If you listen to a Netflix earnings call, their business model is the same business model as my Meetup, where they as my Meetup, where they deliver really good content on the cheap. I'm kind of delivering good content on the free.
Yeah.
But it builds up relationships,
Of course.
Yeah. And reputation and credibility too. So, but also improving my game. So that's my goal personally. Yeah. Okay. Well. Thank you guys.
Really good.
People online, thank you so much. I'm gonna call it a day. I'm pretty talked out.
I won't be able to make it for next week. So
Okay. All right. No problem, man. Thanks so much. I hope I record that. Okay. Stop recording.